and more. And I will be sharing that responsibility with my colleague Susanna Rust, who is here today. So we have an ambitious agenda covering a range of topics, including decumulation, the savings and investment union, infrastructure, and AI. These are all very important topics, and we're delighted to have so many esteemed and highly knowledgeable speakers on the program today from all around Europe. And of course, I'd like to thank you for traveling here and joining us today. So it's an ambitious agenda. We've got lots to get through. I hope it will be leading to some very interesting discussions. I hope that you will take part in the discussions by raising questions and points that will arise during the day in Q&A sessions and, of course, in the lunch and the coffee breaks. So it's a wonderful opportunity to intensively experience some of the most important issues that are going on in Europe today. In this beacon of stability here against a backdrop of geopolitical and market turmoil. So it's wonderful to have so many long-term investors and to really impose a long-term vision in our discussions today. I was going to introduce the governor of the central bank here, Muga Isărescu. Unfortunately, he's unable to join us today. So in his place, we have Lucian Croitoru, who is Senior Advisor for Economic and Monetary Policy to the governor, and he will be conveying essentially the governor's words. So after the senior councillor, we have a number of keynote addresses, so I will introduce the keynote speakers one by one. So with that, over to our opening keynotes. Thank you.
Good morning, ladies and gentlemen. My name is Lucian Croitoru, and I am Monetary Policy Advisor to the Governor of the National Bank of Romania. And today I've been entrusted by the Governor with the task to read in front of you his message to this conference. Here is the message. So I'm reading exactly what he wrote. Distinguished guests, welcome to the National Bank of Romania. It is our pleasure to host here the works of this international conference organized by PensionsEurope and the Romanian Pension Funds Association. We already have a tradition of hosting conferences organized by the Romanian Pension Funds Association. I am personally glad to acknowledge the presence of the European pension elite, pension fund managers, supervisory institutions, and various industry experts. PensionsEurope members manage a combined 5 trillion euros in net assets on behalf of 90 million citizens from 22 European countries. The fact that you are here today underlines the growing importance and deepening integration of Romania's economy into Europe's institutional architecture. I wish to thank the Romanian Pension Fund Association for co-organizing the event and thus making your presence here possible. Also, I would like to congratulate its members for celebrating recently 20 years of activity, not only managing, but also safekeeping pension fund assets, now worth around 33 billion euros for almost 9 million working Romanian citizens. The great merit of your activity in these past 20 years has been normalizing saving for retirement, a practice that is common in Western developed countries and now increasingly in Romania. Currently, 90% of our country's active workforce saves a part of their monthly salary in mandatory private pension funds. The assets gathered this way are mostly invested in Romania's economy, helping foster growth, job creation, and the development of financial markets. Furthermore, this money is now the second largest capital pool of the Romanian population, ranking second after bank deposits. When I started working over half a century ago, this was not possible in Romania's communist economy. In the early 70s, I was a young economics graduate and would only read about this in the literature. In the first very difficult decade of transition to market economy, this idea remained a distant possibility as Romania was struggling with many other social, political, economic challenges. I remember with professional satisfaction that 25 years ago, during my brief term as Prime Minister, my cabinet passed the first plan to implement a pension reform. This was, and I'm quoting, based on a multi-pillar approach with mandatory capitalized funds and private voluntary funds. I quoted from government decision number 556 issued on June the 2nd, 2000. That plan eventually paved the early path for today's successful developments. In the years that followed, the National Bank of Romania continued to support this pension reform. We hosted high-level events such as this one today and advised decision makers to stay the course and improve legislation to foster private pension savings. It is wonderful to see prosperous senior citizens in so-called city breaks throughout European capitals enjoying life in their late years. I assume that they have the possibility to do so, not so much due to the generosity of state pension in their countries, but mainly based on their own savings through private pension funds in countries with decades of experience in this field. As most European countries are facing severe demographic challenges, the shift from traditional pay-as-you-go public system to funded pension will continue. The importance of saving for your own pension plan will become commonplace as newer generations will become more and more aware of this new reality. I will not conclude without underlining the challenges ahead for the private pensions industry as part of the financial sector. We currently face deep geostrategic and political realignments that will, most likely, be long-lasting, causing market volatility and sometimes turmoil. The new digital and AI age will also require professionals in the field to stay sharp and up to date with these developments and use them to improve operations for the benefit of millions and millions of contributing citizens. Ladies and gentlemen, I trust today's conference will be both productive and enjoyable. I end my welcome address here, welcoming you again to the National Bank of Romania, and thank you for your attention.
Thank you to Mr. Croitoru for conveying the Central Bank Governor's words this morning. Next on the agenda, I'm delighted to welcome to the stage Radu Crăciun. As chair of the Romanian Pension Funds Association, he is by default, the most prominent voice in Romania's pension world at the moment. I would recommend that you read his extensive blogs, which are available in English and Romanian. I certainly do. He's a very insightful commentator, not only on what's going on in this part of the world, but also globally. So I am delighted to welcome him to the stage to address us now.
I have to confess it was quite unexpected to have my blog promoted here, but thank you very much. I would like indeed to confirm the strong support that the local private pension system have enjoyed throughout the years from the governor of the central bank. And we are grateful for that because, as you know, occasionally the political context of Central and Eastern Europe was not very supportive for private pension system. And one of the reasons for which we have endured in Romania was as well because we have enjoyed the support of the governor, and he provided a key support in this respect, and we are grateful. Dear guests, ladies and gentlemen, it is my deep pleasure to welcome you on behalf of the Romanian Private Pension Association at the PensionsEurope Annual Conference 2025, The Way to Better Pensions. Compared to the rest of Europe, the Romanian private pension sector was a late starter, Romania being one of the last countries in the region to implement a multi-pillar pension system. However, although we start late, we started right. Our legislation took into account the lessons learned the hard way, both from CEE countries and Western peers. We started in troubled times, the severe and enduring global financial crisis of 2008, and continued to sail the troubled waters with further crises, successfully managing the full spectrum of risks which we faced throughout our existence. We have confronted risk both internally and externally. And as one says, what doesn't kill you makes you stronger. So here we are, almost 18-year-old, proud of what we have achieved, a sound, safe, efficient system which delivered on its promises. A system with an excellent investment performance, given its risk profile, a system that has already started to make the difference in the Romanian financial markets. And even more importantly, is becoming increasingly significant in the lives of Romanian people. The 32 billion euros assets under management are expected to double within 5 years and double again in 10 years, assuming all things equal. It is a growth pace which will require a broader diversification of investment channels, enabling us to have a strong contribution to the Romanian economic development, as relying only on the stock market, on the local stock market, will no longer be enough. And in this respect, we can draw on a wealth of ideas inspired by the older and more experienced similar systems in Europe. As we all know, developing private pension systems is not only about legislators or supervisors, but even more so, it is about fostering the much-needed savings mentality into the mindset of the active population. Therefore, our financial education job will be a long-term, ongoing process. Ladies and gentlemen, we live these days an overly complicated period, unprecedented in some respects, in which we face challenges at every corner. In a world where the population is increasingly disoriented and anxious, we face the huge responsibility of ensuring that their retirement savings will remain in safe hands, being managed with utmost professionalism. In a world in which trust becomes a scarce commodity, we must ensure that the trust placed in us by the people we serve stays as strong as ever. It is not an easy task, given that these days, even the most informed and professional fund managers are in search of the right compass. And until they find it, capital preservation is likely to become much more important than capital multiplication. In this challenging context, this event is an excellent opportunity for us to share insights and expertise in order to navigate together through the stormy waters we currently facing. All this to the benefit of our participants, to the benefit of Europe. I'm looking forward to the interesting discussions and presentations that we are going to see delivered during the conference. Let me welcome you once again and enjoy your stay in Bucharest.
Thank you very much to Radu. Next, I'm delighted to welcome to the stage Klaus Stiefermann. Many of you will know him, of course, in his role as head of APAPR, the German Occupational Pensions Association, but he is speaking to us today in his role as interim chair of Pensions Europe. So delighted to hand over to you, Klaus.
Good morning. As chair of Pensions Europe, the leading voice of workplace pensions in Europe, I'm pleased to welcome all of you to Bucharest. We especially would like to thank the National Bank of Romania for hosting us. What a wonderful venue just in the historical, say, banking center of Romania, a good place to be for pension funds. This year's Pensions Europe annual conference comes just at the right time. The current global uncertainty and the difficult geopolitical and economic context make the situation difficult to read. Uncertainty is the new certainty. With their long-term perspective, pension funds are best placed to weather storms. However, they also need a well-designed regulatory framework to function properly. What makes pension so special and diverse is that they are shaped by unique cultural, historical, and political factors. That is why they are so deeply rooted in national social, labor, and tax laws. The European framework for pensions must take into consideration this important factor and avoid a one-size-fits-all approach that would not work. Pension systems can be a source of stability and security for individuals. To do so, however, they need a stable framework and they need steady-handed policy. Across European countries, first pillar pay-as-you-go systems still represent a major source of income for pensioners in most of our EU countries. However, this is no longer sustainable as public pensions are facing a very challenging demographic, with the age pyramid in the process of being reversed. We believe that occupational pensions and personal pensions should play a bigger role in providing decent and stable retirement benefits for pensioners. We welcome the EU Commission focusing on developing supplementary pensions that can foster potential positive changes through EU member states if properly and carefully implemented. Therefore, the upcoming pension package can be a positive step, but must also consider the basic principle of fiduciary duty, and pension funds must first and foremost provide good returns for their members and beneficiaries. Let me be very clear. The principle should not be jeopardized with political objectives. The diversity of EIOPs and other types of pension funds across Europe must be respected as they are the reflection of historical and social considerations that make them different from all other financial services providers. It should be designed and coordinated with the member states to ensure a proper application of the principle of subsidiarity. We will be keeping a close eye on European developments in the pension field. That's a promise. The range of topics of this conference covers a broad spectrum, and the list of speakers and panelists is very promising. I'm therefore convinced that this year's annual conference will once more provide valuable impulses and lead to many new insights. Let me extend my warmest thanks to the Pensions Europe team and our Romanian friends for organizing this event. And I would especially like to thank all those who will bring this conference to life, which are the speakers, the panelists, and the moderators. Thank you very much.
Thank you very much to Klaus. Now, representing the Central and Eastern European countries' perspective within Pensions Europe, I'm delighted to welcome to the stage Csaba, who is chair of the CEEC Forum, and he will bring essential insight into how this diverse region is tackling pension goals. So I'm delighted to welcome him to the stage.
Good morning, ladies and gentlemen. Thank you very much for accepting our invitation to our annual conference here in Bucharest. I want to thank to all of our distinguished guest speakers for coming, preparing, and sharing their experience with us. I am pleased to return back to Bucharest after so many years. As an ex-OTP person, I worked here at the launching and implementation of the second and third pillar pension funds, together with my Romanian colleagues from 2006 to 2010. But now I want to share my experience, my thoughts from the Pensions Europe perspective. As you remember, the beginning years of 2000 were really busy and intense for all of our CEEC countries because it was the time when our strange, unusual Chilean-based second pillar started their operation throughout the region. In Romania, the third pillar started in 2007, followed by the second in 2008. However, from that date, it passed 17, 18 years, as Klaus said, quite a lot if we take into consideration that it is the time for growing up from a baby to a young adult. Some of you might remember that after this quick start, as I mentioned, we realized that we have to find solutions to the IT developments, to the proper investment practice in the accumulation phase and the administrative challenges, and so on. So cooperation between our countries started very early, and almost all CEEC countries represented themselves in Sofia. Then later on followed different meetings in Bucharest, Prague, or in Budapest. It was really an essential and important teamwork, because after the big wave of our countries' EU accession in 2004, we jointly solved many technical and administrative problems. For example, how can we manage our EU officials' private pensions after returning back to the home country, for example? In addition, of course, after the EU accession, we had to discuss dozens of new standards and regulations. I have to tell you honestly that as an ordinary European citizen, despite the current US political mainstream, I do believe in diversity. Diversity of our nations, diversity of our cultural heritage, diversity of our history, and last but not at least, diversity of our pension fund system as well. Our first pillar B systems are absolutely different than the traditional West European occupational systems. Plus, we started in almost all CEEC countries with a pure DC systems, which was at least suspicious or unsustainable in the eyes of our West European colleagues. We had a quantitative regime for our pension fund investments, while they have had a qualitative legislation. Therefore, in 2006, the predecessor of Pensions Europe, EAPAPR, in European Federation for Retirement Provision, launched the CEEC Forum. I still remember that the Autumn General Assembly, where I was asked to give a short overview of the region supplementary pension system. It followed an hour-long question and the discussion session. And after this meeting, the board decided to launch the CEEC forum, where the majority of our countries joined for the better representation of their interest of our new second pillar pension funds. We had our very first CEEC meeting in Bratislava in the spring 2007, with still a representative of Romania as well. Moreover, through the years, CEEC forum became a kind of bridge, a bridge between the old and the new member states. And through this bridge, we could forward our problems, challenges, toward to the EU decision makers. But time flies. Nowadays, majority of occupational funds are shifting from DB to DC. We are lucky because I know that some of the best experts are here in the room, and they can share us with their experience how the things are going on. Meanwhile, we had some nationalization in Hungary, Poland, and Estonia. Economic crisis in 2008, 2 years of COVID, and more than 3 years in the shadow of the Ukrainian war. However, the majority of our country's second pillars are here, getting stronger and strengthening their supplementary pension system. And one of them, especially, is Romania. The figures are above the expectations. Just at the end of 2024, 8.3 million pension fund members were in the second pillars, with more than 32 billion assets under management, as Keynote said. And the sector has more than 211,000 payouts to the retired members. I am proud that Croatia, Bulgaria, and Romania started the payout phase, means strengthening their position in the national economies as a useful part of the social security systems, offering supplementary pensions to their members. But we can learn more on the accumulation phase in our first session with the overview of the current situation. Our expert speakers will share their experience of the best practices in the EU. Our program for today focuses on the challenges and the possible future of our systems. We are facing with several urgent and long-run challenges as well. Let me mention just a few of them. We have also met with PEP, DORA, FIDA, and their friends. ESG became a part of our everyday life. But new technologies are in the horizons. AI, how, where, and when can we use it? FinTech or pension tech? How can we develop the digitalization of our systems, operation, and products? But these are just examples. We can build up a long to-do list. Dear guests, as you remember, at the beginning I mentioned the diversity. But no, let me draw your attention to unity. If we want to keep our competitiveness in Europe, I mean in EU, we have to unify our sources, our resources, especially in this turbulence and even crazy times. So we can not able to follow even the news from one day to the next day. Therefore, the Commission published a communication on Savings and Investment Union, which contains several ideas, initiations regarding pensions. It includes, for example, the promotion of auto-enrollment as a catalyst of wider occupational pension market, which still exists in Poland and in Lithuania in the CEEC countries. Developing the pension tracking system to increase the awareness of the citizens about their expected retirement income. Review of the EU framework on the IORPs and PEP, improving the offer of pension fund products. Regarding the last topic, I want to draw a kind attention of our decision makers that in the region we still have a stable and popular third pillar pension system aiming to collect mainly the individual savings. But we will have the second session where our speakers give us more detailed information about this. So finally, I would like to thank the hospitality and invitation and organization to the chair, Radu, Crăciun, and the Romanian Pension Fund Association. I also want to thank PensionsEurope Secretariat and colleagues for their work, efforts, and I also want to thank IP for supporting our work. I think interesting topics and presentations are waiting for us, so I wish you all a really useful day. Hope it gives you an extra force for our future work and cooperations. Thank you.
Thank you to Csaba, and pointing ahead to some of the interesting topics that we have today. But to round off our opening keynote speeches, I'm delighted now to welcome to the stage Dan Armeanu, who's Vice President of the Romanian Supervisory Authority and Head of the Private Pensions Division. He, of course, plays a crucial role in guiding the sector's development here in Romania and helping to secure the long-term financial security for Romanian citizens. So delighted to welcome him to the stage now.
Ladies and gentlemen, dear participants, it is a pleasure for me to be here today with a lot of professionals of the private pension sector. Given the major challenges of the pension system, we have to work together to find good solutions. In our history, after the revolution from 1989 until now, there were two important moments for our country. The first one was joining NATO, and the second one was joining the European Union. Joining NATO was very important for us from the point of view of defense, and it can be seen at this moment in the context of the war in Ukraine. Accession to the EU was also very important from the point of view of economic development, because after 2007, the year of accession, the economy grew year after year with significant growth rates. At this moment, a major objective of our country is joining the OECD. Accession to the OECD is a national objective, and our government will take all the necessary steps to implement the reform according to the roadmap. Romania has made important progress in recent years and has already covered a large part of the road to accession. Regarding the private pension system in Romania, this was established 16 years ago according to the World Bank model. Therefore, the pension system in Romania has 4 pillars. Pillar 1, as you know, is the public pension system. Pillar 2 is the mandatory private pension system. Pillar 3 is the voluntary private pension system. And Pillar 4 is the occupational pension system. The last one was created as a result of implementation of the EIOPA 2 directive. The Romanian Financial Supervision Authority supervises and regulates free markets. The largest one is the private pension market, which has around 9% share of assets in GDP. The second one is the capital market, which has around 4% share of assets in GDP. The last one is the insurance market, which has around 2% share of assets in GDP. The assets of the private pension funds are about 30 billion euros and increased by 100% in the last 5 years. The main investments of the assets are in government securities, almost 67%, and 24% in shares of the capital market. At this moment, after 16 years from the beginning, the private pension system has more than 9% share of assets in GDP, more than 9 million participants, and more than 30 billion euros assets. Last year was the best year in the history of the private pension system. Assets increased by 20% in December compared to the same period of the previous year, and this places us in top 10 in Europe. Private pension funds are the largest institutional investors in our capital market. With 94% of their assets invested in Romania, they strongly support the local economy, financial infrastructure, and market stability. At this moment, private pension funds hold more than 25% of the domestic public debt, being strategic partners for the state. Also, the rate of return from the beginning of the system until now is almost 8% per year, and the inflation rate for the same period is almost 4% per year. So the rate of return is double. The rate of return is 2 times higher than the inflation rate. This is just a very short presentation of the current situation of the Romanian private pension system. The private pension system has shown its resilience during the major crisis of the COVID pandemic, the energy crisis, and the instability generated by the conflict in Ukraine. The funded assets have continued to grow, consolidating their position as a pillar of national financial stability. this context, the Romanian private pension system is today one of the best in Europe, being a model of best practices in private funds administration. The OECD evaluation regarding the private pension system confirms that Romania has built a solid, transparent, and efficient system designed to protect citizens' contributions and to offer a secure future. By operating according to clear governance principles, the pension system ensures that the invested contributions provide both security and good long-term returns. Furthermore, the know-how of other European countries is a valuable source that can contribute to the optimization and improvement of the Romanian private pension system. In conclusion, the private pension system in Romania is a robust system and is very well supervised and regulated by the FSA. Furthermore, the system benefits from multiple levels of protection, which applies the highest international standards, including the OECD standards. Finally, I would like to express my deep appreciation for your participation, and I am very confident that the discussions will be helpful for all of us. I wish you to have a debate full of valuable ideas which can generate solutions for the private pension systems. Thank you.
And thank you very much to Dan Armeanu for that presentation highlighting the role of the private pension system here in Romania. We now move to the second part of today's proceedings, making pensions pay off, focusing on the decumulation phase. The decumulation phase was described by the Nobel Prize laureate William Sharpe as the hardest and nastiest problem in finance. Joining us first to give us insights into this area of decumulation, I am delighted to welcome to the stage Jessica Mosher, Policy Analyst for Private Pensions at the OECD. The OECD brings global insight, information, data on private pensions, providing policy and recommendations to its members to foster best practices for the accumulation of retirement savings. So I'm delighted to hand over to Jessica, who will initiate this very interesting discussion that I hope we will have this morning.
Good morning. Thank you for the introduction. I appreciate the symbolism of putting this at the beginning of the agenda. Payout's usually something that we save for the end if we have some time. So it really speaks a lot that we're starting the conference on this topic. Is there a clicker? No, I can't. Okay. Well, I'll ask for slides to change then. In any case, the payout actually, it's a big part of our, oh, it's hiding, sorry, thank you, it's here. The payout is a big part of our policy work at the OECD. As some of you may know, we have a couple of recommendations relating to pensions, and this one specifically, the recommendation for the good design of defined contribution pension plans, includes a principle that relates to the payout phase and states that it's important that we ensure protection against longevity risk. But then it goes on to say that, well, we need to do this in consideration with the design of the system as a whole. And there are actually a bunch of different ways we can go about doing this with respect to the design of the products to do that and the flexibility allowed for in the payout phase. So we're currently, our working party has given us the mandate to develop an implementation toolkit to expand on how we can do this in practice. So this is more or less what my presentation will be today, to share with you our thinking on how we're going about this. And a lot of this, maybe it doesn't work, the clicker, there. A lot of this is coming from our policy work that we've published over the years relating to payout. We publish a lot of this in the OECD Pensions Outlook. For those of you who may not be familiar with it, I hope most of you are. So I've just listed here some of the chapters that have been published that relate to the payout phase for your reference. So what I'm presenting today really draws from a lot of this work that we've done over the years. And I'll cover 6 themes that I think is really important to consider in designing the payout phase. The first is looking at the actual need. So to what extent does the defined contribution plan need to provide protection for longevity risk? The design of different options that are available, looking both at encouraging the demand and supply of these products, ensuring they're sustainable, and ensuring that the people who need these products are actually accessing these products. So first of all, to understand the role of defined contribution plans in retirement, whether they're for financing basic needs, for ensuring some security in case of unexpected expenses, or financing primarily discretionary spending so individuals can achieve the desired standard of living in retirement. To do this, we first need to know, well, how much money do people actually need? And secondly, what are they getting from other sources in the pension system? So on the first question, how much people need, a lot of countries have actually been developing consumption benchmarks, looking specifically at the consumption of retirees, as this actually can differ from consumption of the general population. And doing this in a way that can vary depending on the factors that can contribute to those spending needs, particularly essential spending needs. So household size, whether or not people own their own home, own their own car, their general level of health, and whether they're living in a city or a rural area. And so once we know how much people need, we can then look, what are they getting from other sources, and are those other sources actually sufficient to cover the basic needs? And for example, public pensions. This can also vary depending on personal characteristics. Lower income tend to have relatively more coming from public pensions. And the self-employed, for example, relatively less. So these are other factors we can think about. But once we have a vision and a view of how much people need and what else they're having, then we can situate the defined contribution plan where that fits into the system. And that really is important because it helps inform what products we should be making available at retirement, and what risks we need to manage in particular. So for example, if the plan is really going towards financing basic spending needs, a guaranteed lifetime income is really good for that. Gives people certainty and security, knowing that they're going to have enough money for the rest of their life to finance those benefits. And that's often covered already by the public pension, but where the role of the defined contribution pension is more to finance discretionary needs, we can think about a little bit more flexibility was probably called for. But even here, lifetime income can be a really valuable product to allow people to better budget and optimize their spending over their lifetime. But maybe that lifetime income doesn't need to be guaranteed. A lot of countries are developing more variable lifetime income options in the payout. And this shifts the risk from being completely borne by the provider to being borne by the participants of the plan, but in a collective manner. And this can be interesting, not only from the provider's perspective, because they're bearing less risk, but also from the participant's perspective, because this frees up some of the investment strategies of the provider, because they're no longer investing to hedge the guarantees. They can invest in higher growth assets, and that can in turn also increase the expected income levels of the participants. But of course, with the trade-off that income can be adjusted in light of actual longevity and investment experience. But where we're thinking about more discretionary income, maybe some more volatility, we have more appetite for that income to vary a little bit more. But while lifetime income is probably an option, a good option, and probably the best option in most situations, there are cases where that's not going to be the case, and where we need to think about these two in designing the payout phase. This isn't particularly true where people haven't saved enough to to purchase a meaningful level of income, where their health is poor and they will not benefit from the longevity insurance, or where the market environment is very bad. Do we really want to be locking people into a lower guaranteed income for life if the market just crashed, for example? And maybe there are other situations where it might be, we may need to consider the timing of payments and how that can be best for individuals. So example, flexible access at the beginning to a portion of their retirement savings to help with unexpected expenses or to pay off high cost debt, because that can be a huge burden in retirement as well. Inflation protection may not always be necessary. A lot of evidence shows that consumption as particularly discretionary spending actually declines in retirement. So inflation protection is less important where these plans are primarily being used for discretionary spending. And maybe flexibility around the timing of payments, because in some countries, if people can delay the claiming of their public pensions and thereby increase both their longevity protection and inflation protection. So maybe actually their retirement savings would be well used to help them delay longer the claiming of the public pension and front load some of that spending. Demand for lifetime income is a huge challenge. We know this. It's got its own name in academic literature, the annuity puzzle. So we need to consider this in promoting lifetime income products in retirement. And there are a lot of both rational and behavioral reasons behind this that we need to keep in mind. First of all, the fiscal rules should not discourage lifetime income. This is obvious. This is not always the case though, but people should not be penalized relatively penalized for choosing a lifetime income. Lump sum payments should be limited. People love money now more than they love money later. So we should try to not promote that tendency for people to take more now and not save for later. There are also product features that we can think about to make lifetime income more attractive. Granular pricing, for example, they do in the UK, the enhanced annuities take into account health variables or other behavioral tendencies to price their annuities. And this can actually give higher incomes to more disadvantaged groups and lower socioeconomic groups. But it's not always legally allowed for annuity providers to take these variables into account for pricing. Certain product features can help overcome loss aversion, namely guaranteed periods. If you give people a choice between the certainty of having at least 10 years of their income versus, oh, if they die tomorrow, they won't get any more, that they vastly prefer having a guaranteed period because this alleviates some of that concern over losing their lifetime savings if they happen to die earlier than expected. Communication to nudge people towards lifetime income is also important. We have to make the process easy for them. If we're presenting the products more as consumption, ensuring consumption and income, rather than presenting them as investment products, this also this has been shown to increase the preference for lifetime income products. And also people tend to underestimate their life expectancy to the extent we can increase awareness around the risk of living to a very old age. That can also help increase the value that individuals can place on having longevity insurance in place. Supply is also a problem in a lot of cases, and the regulatory framework really needs to be flexible enough to allow for product innovation and flexible risk management. The rules shouldn't be too restrictive in product design and should allow for beneficial innovation. So one example would be Canada actually had to adapt its regulatory framework to allow for variable payout annuities to be offered for their defined contribution plans, because that was previously not the case. Systemic risk exposures are requirements that impose systemic risk exposures can also impede supply. For example, in Croatia, one of the reasons there was only one annuity provider operating in the payout for the Pillar There's around liability. For people to adapt, and accounting for the available information that we have about individuals, for example, the level of savings that they have. So one example of a really good approach that I think has been taken is Nest in the UK, who has a default payout product for their members that for members over a certain level of savings, they give a portion of that savings goes to a managed drawdown, so they're getting a regular income. A portion of that goes regularly to a liquid account that people can use in case they have unexpected expenses, and another portion is set aside to accumulate to purchase a lifetime annuity at the age of 85. So this really checks a lot of boxes, and people can opt out before the age of 85 if they say, I don't like this anymore, I'm done. They can leave with all of their assets. So that's an interesting solution that kind of ticks all the boxes for the needs that I presented at the beginning of my presentation, and something that has been done quite well, in my opinion. But I think we should really be aiming towards more engagement of people with their retirement savings and engagement with their decisions at retirement. And I think the digital tools like retirement income calculators and dashboards, I think they have a lot of potential to help in this regard. And there are things that we can do also to nudge people towards the right decisions, to help them make the right decisions for their retirement. So I'll stop here, and I'm looking forward to going into more detail in the panel discussion in a bit. Thank you very much.
Thank you very much to Jessica from OECD. And we now move to Carine Pilot-Osborn, pensions team leader at EIOPA, the European Insurance and Occupational Pensions Authority based in Frankfurt, to take on our discussion of the payout phase.
Good morning, everybody, and thank you for inviting EIOPA to this wonderful venue. So first, I would like to thank you, our host, the National Bank of Romania, for hosting the Pensions Europe event. I'm honored to be speaking to you at this annual conference. And as we gather to discuss the future of pensions in Europe, I would like to start with a personal anecdote that highlights the complexity and the diversity of the European occupational pensions landscape. So when I joined EIOPA 10 years ago, I thought I had a pretty good grasp of pensions. I was hired as a pensions expert, but little did I know that I was about to embark on a journey into the wild waste of European pensions. And by that, I mean that the landscape was uncharted territory. Terminology was enough to make your head spin. Of course, I didn't come in this completely naive, as I expected a diverse landscape influenced by different traditions, cultures, regulatory frameworks. But even with that expectation, the reality was still eye-opening. So as I dwelled deeper into the world of European occupational pensions, I discovered that the landscape was not only complex, but also incredibly diversified. I have a slide problem also. So, in 2023, the EIOPA sector managed 2.72 trillion euros of assets under management and serving over 71 million members and beneficiaries across Europe. The trend from defined benefits to defined contribution pensions has become also more pronounced. You can see 10 years ago, 3 out of 10 active members had DC plans, and today nearly 6 in 10 active members live in a DC pension. Market consolidation is still on the way as the number of EIOPs continue to reduce, so by 1.7% between 2022 and 2023. So the occupational pension sector is not uniform across the EU. EIOPs and occupational pensions provision come in different size and form. So with some EIOPs following the paritarian model, some EIOPs can comprise only one member, and a few members states where we have EIOPs who do not have legal personality. So occupational pension provisions are effectively managed by management entities. So what I once thought was a straightforward distinctions at the domestic level between DC and DB pensions became murky waters in my experience as I navigated the complexity of EU-speak and institution. But what surprised me most, and I guess I come to the core of the issue of this session, is still to this day, if you look at the EIOPA database of pensions products and plans, the number of products and plans reporting this database as permitting 100% cash lump sum was still a very big surprise. Setting aside specific cases, of course, where early cash withdrawal may be permitted, I'm pretty sure that a pension is supposed to provide a steady income stream in retirement, not a one-time cash payout. So it's a bit like calling a pizza a salad just because it has some vegetables on the top. So it's not just the same thing, you would agree. So today, I would like to share with you some thoughts on how to make pensions pay off. And I will draw inspiration from recent discussion on unlocking the potentials of European savers. So firstly, we need to acknowledge that the pensions gap is a pressing issue in Europe. 20.2% of senior citizens in Europe are, or 18.5 million individuals are at risk of poverty. This is a sobering statistics, and it highlights the need for a comprehensive approach to address the pensions gap. We need to develop all 3 pillars of a pension system to provide a stable and secure retirement income for all. Promoting occupational and personal pensions is crucial to address the pensions gap and ensure that individuals have sufficient retirement income. And in doing so, we can learn and seek inspiration from member states with well-developed multi-pillar pension system to assist those member states in need of closing the pensions gap. And as we are seeing the trend, the shift from DB to DC pensions, we need to rethink our approach to pensions design. Second, we need to develop adequate supplementary DC pensions, which look at both the accumulation and decumulation design together. And I'm very pleased that today at the conference, we start with decumulation, because often we always focus on investment and accumulation. This is particularly important when member states consider implementing auto-enrollment reforms, which can also increase pensions coverage and promoting retirement savings. However, when designing DC pensions, we need to strike a balance between providing choice architecture for both the accumulation and decumulation phases, whilst also leaving room for those who are more financially capable to make their own choices. We should also consider the importance of pensions taxation in both the accumulation and decumulation phases, as well as the differences in taxation between Pillar 2 and Pillar 3 pensions. Third, it is essential to limit early pensions withdrawal and ensure that pensions are generally used for retirement purposes, rather than being used as a means of accessing funds for other purposes. So having in mind these three aspects, EIOPA is planning to develop a DC toolkit, which will provide guidance to support member states in addressing the pensions gap and promote an active public debate in member states as part of strengthening their multi-pillar approach. The DC toolkit will focus on collecting evidence and practices on the main drivers and barriers to DC pensions adequacy, as well as the main enablers and levers to DC scale and risk mitigation in both accumulation and decumulation phases. We will also examine enhancers to DC pensions protection, such as risk-sharing mechanism and ensuring good outcomes. In the coming weeks, EIOPA will launch a public call for evidence to gather input from stakeholders and experts in the field. The feedback and insight gathered from this call for evidence will inform the development of a two-skill, which is planned for next year. Now, focusing on the payout design, there is still scope for innovation, particularly in terms of addressing retirement needs and providing flexible and sustainable retirement income solution. The EU internal market plays a vital role, in my view, in this regard, as trailblazers in the pension sector across Europe should be pioneering new ways to provide secure and sustainable retirement income for all. But as we navigate the European pensions landscape, I have to ask, are there opportunities to think beyond the traditional notion of a level playing field and to explore new ways of understanding the relationship between market participants and the pensions value chain? In a period of geopolitical instability and uncertainty, and with a need to improve Europe's competitiveness, as highlighted in the Letta and Draghi reports, perhaps we should be focusing on rethinking the pensions value chain and exploring opportunities for each market participant to play to their strengths and specialties. After all, pensions have a social purpose, and it's not just about creating a competitive market, but about ensuring that retirees have a secured income in retirement. There is a place for everyone, and it doesn't have to be the Wild West. We can create a more collaborative and sustainable ecosystem that benefits all, for instance, through strategic partnership. The internal market can also facilitate the development of innovating pensions and retirement income solutions that better tailor individuals' complex work histories, labor mobility patterns during accumulation, and more closely match retirees' income needs during the payout. Thinking of scaling both accumulation and decumulation, we should explore opportunities to extend the investment time horizon and make it more long-term, even more long-term, allowing individuals to benefit from the power of compounding and potentially higher returns. Another area for potential innovation is to look at what is still feasible in the context of risk sharing in DC pension schemes, such as collective DC arrangements and other forms of risk pooling. However, the development of innovative pension solutions is only half the story. The other half is about ensuring that individuals are able to understand and engage with these solutions in a meaningful way. This is why effective communication and pensions tracking systems are crucial, as they provide a vital link between the complex world of pensions provision and individuals who rely on it. Pensions tracking system and effective communications are also crucial in helping individuals understand their pensions entitlements and make decisions about their retirement. The development of min pensions, for instance, in Sweden, has been an important milestone in providing individuals with a clear overview of their pensions entitlements. However, the subsequent introductions of a withdrawal planner, focused specifically on the payout phase, reveals a deeper understanding of the complexity and challenges associated with pensions drawdown. The existence of a withdrawal planner in Sweden on top of a pensions tracking system in pensions underscore the recognitions that pensions planning is a multi-stage process requiring different types of supports and guidance at various points of an individual's life. In 2020, EIOPA delivered its advice on the pensions tracking system, and we welcome the Commission's plan to issue a recommendation on pensions tracking system and its renewed commitment to the European tracking service. Providing individuals with access to their pensions information is the first step towards being better prepared for retirement. And whilst engaging pension savers during the accumulation phase remains a challenge, as people may have other priorities, they may procrastinate. We know engagement will intensify as people get close to retirement. We should not give up on member engagement. As member states are under increasing pressure to develop supplementary pensions, increased participation will also open access to private pension savings potentially to millions of unpensioned EU citizens, giving them for the first time the opportunity to accrue long-term asset-based capital. So whilst engaging with their people with their pensions can be a long-term challenge that may take several generations to fully address, it is essential that we don't lose sight of the importance of ongoing engagement and communications beyond the accumulation phase, extending into the payout phase and retirement itself. As people live longer and the retirement period stretches, their income needs will inevitably vary over time, and the uncertainty surrounding inflation will only intensify with longer retirement periods. This highlights the need for flexible and adaptable pension solutions that can respond to changing individual circumstances, as well as effective communication and support to help retirees navigate these complexities. So in addition to pensions tracking system, we should harness digital innovation to address as many obstacles as possible to pension savings and retirement security. By leveraging digital platforms and tools, we can facilitate the administration of pension scheme, improve communication with members, and provide personalized advice and guidance. To achieve this, we need to encourage good cooperation and collaboration among stakeholders, including governments, regulators, supervisors, industry experts, consumers, organizations, and so that they share best practices and identify areas for improvement. To support this effort, EIOPA will organize the first tech sprint in June, which will focus on harnessing digital technology to address key challenges and barriers to pension saving. And before I conclude, I would like to take a moment to express my gratitude to PensionsEurope for hosting this conference and for their good cooperation with EIOPA. I also appreciate their latest work on the design of payout, which will have a presentation shortly, which will foster important discussion on the need to develop adequate supplementary pensions. EIOPA looks forward to the contribution of PensionsEurope and its members to our upcoming call for evidence, which will inform the development of our DCQ toolkit. And then, of course, your input and expertise will be invaluable in shaping the future of pensions in Europe. And we are eager to hear your thoughts and ideas on how to create a more sustainable pension system in Europe. And so I conclude my tale of the EU pensions Wild West. We are reminded that even in the most uncertain of territories and current volatile times, we as a pensions community have and will continue to navigate the challenges and obstacles. And I am more than convinced than ever that together we can find a new frontier to create adequate and sustainable supplementary pensions that will benefit generations to come in an inclusive European society. So I thank you for your time.
Thank you very much, Carine. Hello all, as Liam introduced me before, but I'll do it again. I'm Sue Rust. I'm ESG editor at IPE, but I have a penchant for EU pensions policy, so I'm delighted to be here. And for the next step in our examination of making pensions pay off, I'd like to introduce Francois Barker, Senior Pensions Partner at Eversheds Sutherland. Francois may be familiar to many of you. He has nearly 30 years experience of pensions law and has been playing an active role in shaping or trying to shape the development of pensions in the UK and Europe. What he's going to talk about next is a small example of that. Without further ado, Francois, would you like to come up?
Well, good morning, ladies and gentlemen. Thank you, Sue, for the introduction. After that, I can hardly wait to hear what I'm going to say. If we are in the pensions Wild West, then perhaps I can be a little bit of a sheriff and introduce a bit of order with introducing Pensions Europe's latest publication, Decumulation in Focus. You have it on your chairs. It's great bedtime reading. So in the next 15 to 20 minutes, I'm going to take you through some of the elements in the Pensions Europe report. I and my colleagues at Evershed Sutherland were very happy to work with Pensions Europe and the entire Future of Pensions Steering Committee in developing this important publication, which provides you with a pretty comprehensive view of the risks, the challenges, and the options for decumulation across Europe. So I'm going to do this in 3 chunks. First, I'm going to build on what the previous speakers have talked about in terms of why decumulation is so difficult. Then I'm going to look at some of the options that we currently see, and they're not all about a lifetime income. And then lastly, I'm going to draw on a bit of research from the UK that shows what can go wrong and therefore how we can do things differently to make it go better. But I'm going to ask for your involvement in this because you've been very patient for the last hour and a bit and you've listened. So I would like you to get your phones out. You are permitted to get your phones out. And I would like to invite you to scan, if I can bring it up. Can you move the slides on for me? You will soon get a QR code on one of the screens near you. Scan that with your phone, and it should take you straight to a poll where you'll be able to answer the question, what's your instant reaction to all this talk of decumulation? Can we move the slides on? It is not easy, you're right. I'm not taking this personally because it's happened to others as well, but the clicker is not working. Bear with me. Okay, there we go. So if you scan that QR code, it should take you straight to a Slido poll where you'll have the chance to say what your instant reaction is to all this talk of decumulation. Is it, thank heavens, it's about time we talked about it? Is it irrelevant to me because my jurisdiction, my company, my country is DB, or is simply as pay as you go? Is it tomorrow's problem because we're still building up DC pots? We haven't started drawing them down yet. We can't trust DC savers to make a good choice, so we should decide for them. It's important they do have a choice. They should have freedom in how they use their hard-earned, hard-saved pension funds. Or you might just think, what on earth is decumulation? Is that working, QR code? Are you getting the question? Great, okay. So I'll give it a couple more seconds for those that haven't yet responded to respond, and then we'll see what you think. So 5, 4, 3, 2, 1. So the results, if you can move the slides on for me. This is just to heighten the suspense. There we go. Okay, interesting. So most people are where the two earlier speakers were. It's about time we talked about this, and I'm in the same place, and I'll explain why. And otherwise, there's a bit of everything, isn't there? What is decumulation? Very good question. It's a horrible term, isn't it? It's a very complicated term for something that is actually quite a simple concept. So if we can move the slides on, please. I'll need to get you to do this, I think. What's decumulation? It's simply the process of converting a DC pot of money into benefits that you draw through your retirement. That's all it is. It's the opposite of accumulation. How hard is it? You heard earlier Liam say that William Sharp described it as the nastiest, hardest problem in finance. I think he said that before tariffs were invented, but it's still probably one of the hardest, nastiest problems in finance. And if you want a slightly more jovial, upbeat, entertaining view of decumulation, the Australians think of it in terms of managing short-term retirement, what they call the go-go years, medium retirement, what they call the go-slow years, and then late retirement, what they call the no-go years. But either way, the idea is to manage your risks of that pot running out of money to take you through your retirement. So if you just move us on, please. So why is it so difficult? Another poll for you. Actually, it's not a poll. I'd like you to just scan the QR code, or your phone may take you straight there, and put the word in or the phrase that you think makes decumulation so difficult. You might think it's about freedom. You might think it's about choice. You might think it's about stability. And as you enter those words, they'll come up on the screen in real time. And the more people that choose a word, the bigger it will get. So we'll get an unscientific view of what this audience thinks matters. So there's some great ideas there. Love uncertainty. Yeah. What do I do with it? I'll give you an example from the UK that just bears that out. Not enough money goes to adequacy. I agree with that. Decumulation can only work with the pot. Regulation, quite agree. Flexibility and stability, I quite agree. You don't need me up here. You've answered the question. You don't need to read the report either. You've answered the question. So look, there are some great ideas there in terms of the real challenges with decumulation. And all the points you're raising there are great, and they're all in the report. Some of the things that we concluded mattered when we wrote the report, if you can move the slide on for me, please, are these 16 things. In a moment. Next slide. Great. So a lot of the points up there are ones that you've already flagged, and you'll find them raised in the Decumulation in Focus report. If I just picked out 3, top left, choice or not, there was a real difference of view amongst those who contributed to the report about whether you should give people at retirement a choice about how they spend their DC pot. And that's a challenge between a flexible liberal economy that believes in choice, and on the other hand, saying it's just too important. We can't let people run out of money too early. If I go to the second column from the right, the growing reliance on DC, it's probably fair to say that people retiring with DC now have got something else as well. They've probably got some pay-as-you-go public pension. They've probably got a DB cushion that means their DC pot is not that important in terms of taking them through retirement. But we are soon coming to the first generation of DC-only retirees, when all they will have is their DC pot, and they will have to make it last, and these things will become really key. And then the third one I draw out, picking up some of the points made in the last talk, was engagement. Do we want to engage people at retirement or not? Because if you think about the way DC is building, a lot of that is thinking about automatic enrollment. It's doing things to people. Automatic enrollment works because it builds on apathy. You do it to people, people don't have to think. And it's going to be a challenge if we use automatic enrollment, as is being used or thought about in a number of jurisdictions, most currently Ireland. If you use automatic enrollment to get people into DC by apathy, it's going to be doubly difficult to get them to engage in a complicated process like decumulation when you get there. So the thought about a default in decumulation, I think, can't be dismissed. I think we're going to have to do something for those that remain apathetic. Okay, just move on to conclude. Why is it so difficult? The first, oops, back one slide. There should be another slide in there. It's going so well. There we go. No, there isn't a slide. It's obviously okay. Not to worry. So why is it difficult? It's all those 16 things. The second thing I was going to cover was the various options that we see around Europe now in terms of decumulation options, and they spread from what you might call the stable or guaranteed elements on the left through to the flexible elements on the right. So obviously the most stable, the most guaranteed is the fixed annuity that could link to inflation. You know what you're getting, but it comes at a price. It's inflexible, and if you die early, you might lose some money from it, but it will not outlive you. You will not outlive the annuity. You have some jurisdictions that are using collective DC or variable annuities, the Netherlands being one. The UK has started dancing with collective DC, and that provides you with an income, but not one that you create yourself. That's one where the individual stands back from his or her retirement pot, and that's managed collectively by experts subject to a fiduciary duty, and they pay you a pension that they expect to be about the right level, but it's not guaranteed. So you get better decisions, you can take account of longer term financial planning, but you don't have an absolute guarantee in terms of the amount of the pension. Lump sums, are they good or are they the devil incarnate? I'm hearing a bit of both this morning. So lump sums are the ultimate flexibility. You can take the money and do what you want with it. You either think that's a good idea because it frees people up to spend it, to pay off mortgage, to pay down debt, to pass it on to their children, or you think it's a bad idea because once you've taken it, you can't use it to generate a lifetime income. You spend it and it's gone. And I'll come to an example of this later on in the UK where, as the law stands right now, you can take, if you wish, 100% of your DC pot as cash. Now, whether that will remain the case, we wait and see, but at the moment that's the case. And then on the far right, you have the kind of flexible drawdown. You leave the pot invested and you draw an income from it that may fluctuate, vary depending on your needs. And that provides you with some flexibility, but not an absolute guarantee. So all those have different advantages and disadvantages that I've just gone through very briefly, and the report goes into them more. Can you move me on a slide, please? Thank you. They also raise some important questions. Sorry, you'll need to move me button by button, please. So the advantages and disadvantages of each. Next one. Should there be choice at all? Bear in mind that even if you don't give the saver a choice, somebody somewhere will have made a choice about how much choice they have. So you can't avoid choosing somewhere. Can you mix and match to create a hybrid solution? You can. I'll give you an example in a moment. Do you, as an economy, as a matter of policy and principle, prefer freedom or protection? Or do you want to be somewhere in the middle? And then finally, because I don't think you can avoid a default altogether, what does one look like? Really difficult for all the reasons the last speaker outlined. The range of risks and variabilities in decumulation are much greater than in accumulation, much harder to create a proper, sensible default. Okay, so that's the second part of my talk, which is looking at the options for decumulation as we found them in the report. I now want to ask for your input again, but this is verbal rather than using your phones. This is a bit of research from the UK, which shows what can go wrong. So one insurer in the UK thought, what's going to happen with automatic enrolment in about 30 years' time, 35 years, 25 years' time? And they calculated that they would have a lot of people retiring in the 2050s with nearly £250,000 sterling in a pension pot, a DC pension pot. That is a lot of money, and probably more money than these people have ever had before. Hang on, stop. Okay, so you've got the answer to the first two. 3.4 million are in that bucket. 52% of them said, I wouldn't know where to start in deciding how to draw down on that pot. If you work out 3.4 million times 225,000 times 52%, you end up at something like 400 billion. That's 400 billion pounds of sterling in the UK alone that is at risk of being used unwisely, put to bad use, not being productive. If you scale that up across Europe, you can see how important the issue is. The numbers are colossal. Don't press the button yet, please, at the back. 1 in 10 people said they would do what with it? Any idea? Take the money. They said, yeah, I'll take the whole lot in cash, please. You can press the button now. And I've given you part of the answer there. So the question mark needs to move. That would, in each case, under UK law, this is UK law, generate them a tax bill of £70,000 straight away, which is equivalent to wiping out 15 years worth of their contributions. So if you leave people alone at decumulation, if you just go, my job is done, there's your pot, very bad things happen. or are likely to happen. So this is what can go wrong, a lot of money going in the wrong direction by people who don't feel equipped to make decisions where there is no sensible default. Okay, so what can we do right? So the same insurer in the UK thought, what can we do as a hybrid structured solution? And this is quite similar to the Nest one that was talked about a moment ago. How can we blend flexibility, stability, protection, and also attack the issue that at 80, around 80, 85, people become less able to take these decisions. Cognitive decline steps in. So this solution looks at flexibility in the early years. You take your 25% tax-free lump sum at the moment that is permitted in the UK and in other jurisdictions too. 45% of the overall amount then goes into a flexible drawdown pot. You're investing it, you're drawing an income from it that's not guaranteed, and that fits with the idea that you're mentally equipped at that point to continue managing that process with the benefit of advisors and expert providers. But around 80, you lose that ability. And that's when you need the guarantee of a stable retirement income. So at that point, you use 22.5% of the pot to buy an annuity that will take you through the rest of your life. And under all of that, there is a 7.5% pot for occasional spending. That might be treats and holidays or a car. It might be to pay off debt. It might be for medical or care needs, which are increasingly difficult to predict. So that is not a magic solution. That is not the only answer. And I'm very mindful it's only from one jurisdiction, but it is an idea of the thinking that's going into this to avoid the problem of people not knowing what to do in decumulation. Okay, let me conclude then just with some final closing thoughts, if I may. So decumulation involves some really difficult policy choices, difficult things like freedom, choice, solidarity. Do you want to do this on your own or with other people? Stability, communication. How do you engage people? Do you want to engage people? Do you think they should have a choice? What's taxation going to do? What's inflation going to do? What are the costs and charges? There's 101 really difficult policy decisions behind decumulation. Those need to be thought about well ahead of time. Because if you wait until people are about to start decumulating, you're not leaving them in a good place to make those difficult decisions or take those difficult choices. And you need to do that ahead of time so that DC savers have the confidence to save for their retirement. We want them to do that. Pay-as-you-go systems are not sustainable for the long term. It allows them certainty, allows them to plan ahead. Now, there were one or two people, not many, but a few people on my very first slide who thought decumulation is tomorrow's problem. Pay-as-you-go is working fine. We're DB. We're still accumulating DC. It's much too early to think about decumulation. I would say, Pensions Europe would say, the Future of Pension Steering Committee would say, that's wrong. This is precisely the time to think about decumulation for all of these reasons. So the time for that is now, and we very much hope that reading Decumulation in Focus will help you in your thinking. Thank you very much.
Thank you very much, François. That was engaging and educational and stimulating. We're going to take this further, I think, with our first panel discussion. And to set that up, I'd like to introduce Matthias Verstengen. Matthias was once staff of Pensions Europe, but he's now head of the Brussels office at Pension Federati, the Dutch member of Pensions Europe. Matthias, I'll let you take over from here.
Please, all these speakers of this panel, I think you can already come up, so I can introduce the ones that have not spoken yet and set the scene for the panel. I mean, first of all, congratulations to all speakers for setting out the challenges of decumulation in detail, yet also in brevity, because I think we are ahead of schedule, which is an absolute unicum, I think, for a Pensions Europe conference, which means that we may have a little bit of extra time for the lunch break for networking, which I think is great. So the academic intellectual challenges of decumulation have already been set out. I also think decumulation is important because it really gives the identity to the pension product. Is it sort of a social insurance that guarantees that you have income in retirement? Or is it more of an investment asset management product that gives you good returns, but then hands over the reins to the individual? We have a distinguished panel to give perspectives on this question from a national, European, and indeed global perspective. Carine and Jessica have already spoken and introduced, so I just have two speakers to introduce. On my right-hand side is Michael Jones, who is pension partner and head of DC pensions at Evershed Sutherland, and he has a long career in pension law, advising DC pension arrangements, master trusts, DB master trusts, and other consolidation vehicles, and he can share experiences from the UK, which I think are very relevant for this discussion. And then on my far left is Geerke Witteveen, who is the CEO of NN Romania Pensions. When you hear the name Geerke Witteveen, you don't immediately think of a Romanian, and he is indeed a compatriot of mine from the Netherlands, but he has been working here already for a long time, as well as in the Netherlands, so he's a true veteran of pensions and insurance, and really championing the economic relationships between the Netherlands and Romania. He has also been the president and a board member of the Netherlands-Romanian Chamber of Commerce. So let's start at the top and then zoom in. So we're just gonna, be like Google Maps and scroll from the global European to the national level. So I start with Jessica, who at the OECD looks at individual country or at their member countries, their private pension systems, as you like to call it.
Funded pensions.
Funded pensions, supplementary pensions. Indeed, it's always good to think about what organizations are talking about when they use certain words. You gave an overview of the principles that the OECD thinks are important in DC decumulation. And on the one hand, you underline the importance of lifetime income solutions, but you also see room for flexibility and individual choice. So I'm wondering, do you think that there is a trade-off and a sweet spot in the middle? Because if you want to get as many individuals as possible into lifetime income, you might also get some individuals there who actually would be benefited by individual choice, and the other way around. If you give a lot of individual choice, necessarily there probably will be some individuals who actually should be more on the annuities side, be it variable or fixed. So do you think there is a sweet spot in the middle, and are there some examples of how you can do this?
Thank you. I think it's important that we're even starting to think about the sweet spot in the middle, because I think that there's been a tendency, I think, either because this question is so hard, there's been a tendency in policy to say, we don't have the answer, that kind of two extremes that Francois presented earlier. We don't have the answer, so let's just let people do whatever they want. Or, lifetime income, people can't make the proper decision, so everyone has to buy a lifetime annuity, and that's it. And those are the only two options. So it's nice that we're now starting to actually have this conversation about what are the other options involved, and think about what the right solution could be a bit more. But yeah, so there is clearly a trade-off, and I don't think anybody has quite found that sweet spot. I think some of the examples that Francois discussed as well, and the Nest example, I think they're getting there, but I think it's really important that as policy we start thinking about what role we want this to play, because I do think there's a big difference between, are we really expecting these this to finance basic income needs. And there, I agree, mandating an annuity could be appropriate because we have interest in ensuring that people have sufficient lifetime income to finance those needs. But if we're just trying to promote people to save more for retirement to improve their lifestyle, then by nature, because that's their choice, we should be allowing for some more flexibility. But with that said, I said earlier that lifetime income is still really valuable. There's a lot of evidence that even just reference rates in terms of drawdown, people tend to stick to that in their budgeting purposes. So if you give them a lifetime income, it will greatly help them budget. And the fact that it's lifetime allows them to really optimize their budget over their lifetime. So I think there are some countries that are, I think what the Netherlands is doing, they've recognized the need for a bit more flexibility in allowing for the lump sum. So I think that's quite good, while still ensuring that lifetime income will be there. And the fact that also that it's not guaranteed means you're not actually locking people into this potentially low level of lifetime income, but you're really allowing them also to benefit from the upside. So I think that's a positive thing.
Thank you, Jessica. Then moving over to Carine. EIOPA is a supervisor and has looked a lot at prudential issues, supervisory issues. But for a number of years now, the pension gap has also, been one of the policy priorities of EIOPA, and the pension gap is significant in quite some European countries. Bearing that in mind, what are the considerations that EIOPA thinks are important in designing a payout phase when it comes to addressing that EU pension gap?
Thank you. So so we have yet to do the work. This is what we are going to stick call for evidence. So what I give is a provisional answer because I think we're in a listening mode. But I think there are several factors that we will consider. So first of all, the sustainability, because in the end, the deal of decumulation is to have stable payments in retirement over the long term. Another aspect is flexibility. I think we've heard it quite several times through the different presentation. The aspect of protection, longevity risk, inflation risk is also important. We heard about engagement, so transparency. Let's not forget that in some member states, who are heavily dependent on the first pillar, there will be some concerns and it's society's choice as well to go into capital markets. And I think it's also important, and I know we will come to that later, in the context of a savings and investment union. People need to have trust, and the track record of financial services is not the greatest. So if we want people to invest more to save for their retirement in asset-backed pensions, then we also need to be quite transparent. Simplicity will be important, both in terms of maybe presenting the choices, but also communicating these to people so that you increase the engagement, and also transparency on the cost efficiencies. Jessica was just mentioning, the aspects of, forcing annuitization. We have to remember that not so long ago, we were in a low interest rate environment, and actually full annuitization was probably not the best solution for most. So, and what is also interesting from a supervisory perspective, because EIOPA is a board of supervisor, I was thinking of a previous presentation from Francois on the, what's happening in the UK, and with this trend to DC, and also in the cohort of people who will come with these choices, and also bigger pension funds that have never been seen before, and relying more and more on their supplementary pensions. we will also need to change a little bit the way we supervise. I know the DNB in the Netherlands is also thinking, okay, it's not so much focusing on the funding requirements as you move to the new DC contract, but this also means that a supervisor, so they will continue to look at the prudential aspect, but not just the investment, also the outcome and how they have this conduct DC outcome still have an implication from a prudential perspective, and also a lot of conduct risk that will come in respect to if you give and allow some choices, then there will be also some issues on the issues. I mean, some aspects of conduct risk that supervisors will need to have a look at, and depending on whether the model is Twin Peaks integrated supervision, of course, there will need to be an extent of collaboration between the supervisors as well.
Okay, thank you. Before we move to the national level, I just wanted to pick up on something you mentioned during your presentation. You said we also have to look at the internal market and all the roles the different stakeholders play, and perhaps there needs to be a bit of a shakeup. I think you were expressing yourself quite diplomatically and carefully, but can you maybe shed a little bit more light on what you were alluding to, and what is the problem with the current sort of setup of the way the pension market operates that we need to tackle?
So I think Jessica mentioned that, of course, as more DC pots build across Europe over time, first of all, there will be a supply issue for certain markets, because I'm not too sure if we all went for annuitization, would actually everybody be picked up by life insurance? That's one question. That's where the single market is important. But if we develop also some solution, be it from a pension funds perspective, what I am missing, and I often look also a little bit on the PEP, is there's so much discussion on, who's going to provide the PEP and how it's going to work. Whilst really, if pensions are there for a social purpose, I think there could be more collaboration and partnership, with asset managers, life insurers, pension funds, so that you get the best out of each specialty. So I'm not saying that there are issues, but I would like to see more innovation around how everybody and market players work together to try and get the best outcome for the EU pension savers.
All right, very clear, thank you. So then moving on to the national perspective, we have two pension markets, sort of the very mature UK pension system and a much younger Romanian pension system. Starting with the UK, Francois already alluded to the experience with the pension freedom in the UK, and that there are some lessons to be learned, that not everything is going 100% well. Can you shed some light on the experience today, and what would you say other countries looking at decumulation can learn from that?
So I think it's just worth taking a step back and sort of giving a bit of a background as to how that freedom and choice came in, because we've had in the UK auto enrollment for about 15 years, which, as Francois says, is a system based on apathy, inertia, having things done for people. Then we had freedom and choice in 2015 that effectively said, ignore the apathy. When you approach retirement, you have to start making choices for yourself. And we've had that system now for about 10 years. And there's a real trend in going back on that freedom and choice, because people just aren't taking a retirement income. And there's a couple of reasons for this. First, because the pot sizes just aren't big enough. So on average, give or take for male or female, pot sizes are about 50,000 sterling, which means that people are taking that all as cash. And some of the issues that Francois' slide showed with the tax implications of that are quite stark. And because of that, people then just don't have enough retirement income, retirement adequacy, and are reliant on a fairly substandard and mediocre first pillar state system. So that's the broad issue that we have in the UK. But we know that as savings continue, the size of those pots are going to increase. And so there is a real pressing need to try and remove that behavioral trend towards people taking cash. And I think part of the problem is how it's positioned and labeled by the government. So the government talks about it as a tax-free lump sum. Why wouldn't you take it? It sounds almost like free money. The problem is, though, that under the tax rules, that lump sum has to be linked to a pension. So if you take that lump sum, you are, whether you know it or not, making a clear decision that within 12 months, you have to take a form of pension. Now, that might be an annuity. It might be some of those drawdown flexible options we discussed in the previous session. But that is a fundamental difference between how the tax regime is set up and how people are behaving. And that is then driving a lot of the issues that we see around inadequacy and running out of savings and not using savings in a sustainable way. The other trend that we've seen is that people just do not take annuities. So even in more favorable economic climates where quite recently annuity rates have looked quite favorable, they underestimate their longevity. So the annuity probably is fair value, but to an individual, it doesn't look like that. So there's a really worrying trend towards falls in annuity rates. To give an example, between 2013 and 2024, there was a 3/4 drop in people taking annuities. So it's unpopular. Conversely, when UK society is asked what they want from retirement, they always say a guaranteed income, but they say they don't want an annuity. So a fundamental lack of understanding around what an annuity actually is and what it provides. But that's a behavioral education piece that is fundamental. The other, looking at it on the sort of top end of the spectrum, so the more sort of higher earner end of the spectrum, a lot of people take their DC pot and do nothing with it because they want to leave it to their family. They want to leave it to their beneficiaries. And they view it as a savings vehicle rather than a pension. And that's something that the government is trying to reverse. There are plans to put inheritance tax on unused DC pension pots that will start to move that trend from using it as a favorable way of leaving money to beneficiaries. And just the final thing that I wanted to touch on with where we are in the UK in terms of how people use their DC pots, we are seeing, and Jessica mentioned it earlier, we're seeing a worrying increase in the amount of people that need to use their DC savings for rental income in retirement. Home ownership is dropping quite considerably. And when we get the first wave of DC-only retirees, a lot of them, more than 50% based on current studies, will need to use that for rental income. And some of the industry work that has been done in relation to looking at what is needed for a comfortable income doesn't in any way include rental income. So again, there are some societal economic issues that are feeding into how people take their pension savings and types of things that they need to have in place for them.
Well, we're in the UK, because I think the UK is doing some really interesting things to try to address the challenges in light of the pension freedoms and trying to get people to engage after being auto-enrolled into their pensions. So maybe you can comment on some of these things as well. I think that the FCA is looking more into the targeted support regime. So this is essentially because the challenges in people in accessing financial advice, both in terms of willingness to pay or affordability, but the general provider's reluctance to provide that advice for fear of legal liability. The FCA is currently looking at how to allow providers to predefine certain categories of people, cohorts, or based on their personal characteristics, and say, given these characteristics, this is the type of solution that would probably be good for you, and allowing them to actually make that recommendation on that basis to individuals. And so they're hoping that this will really help people, the delivery of the right products to the right people. So maybe you could comment a bit on that, on how you see that evolving. But another thing I think is interesting is that they're also putting more onus on the providers themselves to make sure their products are appropriate and that they're being sold to the right people, and that consumers understand the whole journey they have to go through the new consumer duty, that there's onus on providers to make sure they're communicating to their clients in a way that they can understand and that they can engage with. So maybe you can also comment on some of those, because I think this is, you're doing a lot in this space, and I think it can be a good example for others.
Thanks, Jessica. So yes, and the reason why the regulators in the UK are looking at these types of things is because there's a huge gap at the moment around people taking generic guidance, so looking at the options that are available to them, and then financial advice. And no one is willing to pay for financial advice. And so there is a worrying trend towards people taking uninformed decisions. And that trend is getting even greater. And so there is a need to find something, as you mentioned, in the middle that is cheaper, that's more accessible, but that doesn't involve a personal recommendation. And so the regulators, in particular, the Financial Conduct Authority, have proposed what is known as targeted support, exactly as you say, to give individuals the framework to say, people like you with these types of characteristics, with this size of pension saving, tend to do this, and then almost guiding them into that solution. I think that is a positive first step. The question, though, comes whether you should be using those sort of tools within defaults or not. Because at the moment, the UK government is really looking closely at whether they should require fiduciaries to put in place default arrangements. And things like targeted support would be a really good supporting tool for a default arrangement, because effectively you would need to give people all of the information up front about what the default looks like, and as they go through their savings journey, what the correct default solution for them is. It goes back to communications. So we mentioned the importance of communications. From my perspective, communications should start the minute someone joins a pension scheme and they start making contributions to that pension scheme. And they should be told that if they do nothing, that's okay. But if you do nothing, this is what will happen. So you will accumulate up to a certain point, and then at a certain age, you will go into the retirement solution unless you choose to opt out. I think there's always got to be an opt-out, because we need to build in that flexibility. And whatever fiduciary you are, whatever pension scheme you are never going to be able to do everything right by everybody, because everybody's financial circumstances are different. But what I think you could and should be doing is to say, we are going to design something that gives a good income for the majority of people. And if there are people with different financial circumstances or who are more sophisticated and financially literate, then they can opt out and do something differently. And I think if we start that from the beginning, building through multiple decades to the end, that is the way of increasing engagement, but also providing the good outcomes that individuals need.
Thank you, Michael, for highlighting some very specific national issues, but I think also a lot of sort of behavioral issues that are, the same in all our pension markets. So let's bring it over to Gerke to share the Romanian perspective. Completely different pension market, still very much accumulating. Decumulation is it still something for the future, or have you started working on it? What are the challenges in decumulation in Romania?
So thank you, Matthijs. Yeah, I think first off, I think yes, Romania is a different market than the UK, much less advanced. Still in the accumulation phase, and we talked about not one size fits all. But at the same time, if you listen to the challenges and the discussions, there is quite a lot of similarity, I think, true between countries. Some of the human behaviors are quite, I would say, prevalent across nations. So if I try to put some Romanian numbers behind it, and that's very specific for Romania, and projections are always a bit, difficult, but to try to make it a bit concrete. In Romania, when we do research and we ask people, what do you expect at retirement? Starting from that, they say we expect roughly between 70 and 80% of our last earned salary to be our lifelong income beyond retirement. And I think these are percentages that probably resonate quite similarly across most geographies. That people intuitively, and whether they're right or wrong, there's a whole thing on what do they really need. But intuitively, that's where people are. Yeah, that's what they think they need usually after retirement to have a decent lifestyle. And I think the pyramid that Jessica presented at the very beginning with the 3 steps kind of refers to that. But then we look at the Romanian system right now, where still the majority of people having pension now is Pillar 1. And they get about 40% on average. And again, these are averages, so it's very difficult to, for some it's different, but let's say 40%. So there's a gap of 30%. We see the current Romanian retirees, they deal with that gap sometimes if they have the ability with their private savings and the wealth they accumulated. Romanians tend to own real estate in general. That can become a source of income by eating up the value of their real estate. And some people still, they need to adjust their lifestyle quite considerably upon retirement. So that's where the Pillar 2 system came into play. The reforms, it's the demographics, we discussed that. And if we make projections, and again, that's quite dangerous to do, but the Association of Chartered Financial Analysts in Romania did publish a report in January. They said that about 42% replacement ratio is likely to decrease to 30% in the 2040s because of demographics in the state increasingly having difficulty fund. The Pillar 2 system where we're saving now should add another 17% replacement rate, bringing the total to about 50. So we move from 40 to 50, positive development, still a 20% gap. So we're looking at how to fill that. We have the 3rd pillar, the voluntary pension system. The people who save there, if you make based on the Pillar 2 statistics, kind of an extrapolation with current average contributions, it could add another 5%, but only roughly 10% of working population currently has a Pillar 3 pension plan, a voluntary pension plan. So that will solve the problem maybe partially for 10% of the population as we are today, but not more. So there are all these sources of income with private savings that come together. And I think for the payment phase in Romania, what will be interesting as we are starting to prepare the discussions on getting legislation in place, is how do you combine all these sources of income? So it's the private savings, the voluntary pensions, the mandatory pensions into one sort of payment scheme, one payment phase that will in the end ensure that gap between what the state can provide as pay as you go. So we're not yet at full DC pensioners as in the UK, but and that gap. And I think a lot of the questions about adequacy, about choice are there. Right now, if we look, people say they want, again, similar to what Michael was saying, people say they want a lifetime income. But if you ask them today to choose what to do with their pot, they choose the lump sum. Yeah, as of today, people have a choice when they get payments between a lump sum or 60 monthly payments, so basically 5 years of a stable income. That's the only thing the legislation provides for right now. And even then, we see that the majority of people currently chooses the lump sum. So there is a percentage that chooses these 60 rates, but it's still the minority. So we see that behavior. So again, that cognitive dissonance is very similar to what Michael described. So I think as we navigate this legislation, we will need to cover that. And I think some form of default or some form of strongly guided advice, as Michael, I think, will need to be part of that legislation. And I think what is dangerous in a way in this is that we now talk about the here and now, and we set the policies, and then we think we can fix them for 20 years. If we fast forward 20 years and these percentages start shifting and people start educating and getting used to that, you know, we're sitting here as pension providers and maybe as authorities thinking, okay, people don't have the knowledge, people can't make the choices, let's go for default. Probably 10, 15, 20 years from now, and I'm curious to hear maybe experiences from more advanced markets, people become more aware and probably over time become more able to make their own decisions. 10 years is still a limited history, but I don't know if there are examples somewhere in OECD. So the question then is, how do you make legislation that is not only valid for today's reality, but for, can survive 10 or 20 years, because we don't want to rewrite the laws every few years. So this is kind of where we are in Romania.
So I think it's really interesting because in the UK, we look a lot at Australia. They are a far more mature system, DC system than we are. The Australian superannuation schemes have been going for 40 plus years, and the size and scale of them dwarfs those in the UK. But really interestingly, because Australian generally have bigger pots, so they're more the sort of 200 to 400 plus equivalent of sterling, they tend to be far more conservative in their withdrawal rates because they are so concerned about running out of money, because their behavioral society says that that pension pot is so important that if they use it too early, they know that they'll have nothing left. And so there is a real case for almost prescribing or being very clear on withdrawal rates based on an individual's longevity, so that you don't run out of money, but you don't fall into the Australian trap of not withdrawing enough and inadvertently having a poorer retirement than you would need to. So I think that's the lesson that we in the UK are learning from other countries with a more mature system. The other thing that I think is really interesting about all of the discussions we've had today, and we talked about lump sum a lot, but some of the retirement solutions that Jessica and Francois highlighted do almost have facility for that lump sum. You just don't take it straight away. So you have a sidecar or you have a particular fund that you access for holidays, treats, cars, but it's about positioning it so that it doesn't need to be taken straight away, and that it can be held in reserve and be accessed when an individual wants, because that is the flexibility that, in my view, individuals are looking for when they go and take their lump sum straight away. And they want to know that they have the money there ready to access when they need it. So I think there's a behavioral structural point that policymakers and regulators can look at by saying, we know people like lump sums, but how can we structure arrangements so that they don't have to take it straight away and they don't feel the need to take it straight away, but they still have trust and confidence in the system that it won't get eroded because they're leaving it there invested. And I think that's really important to provide the flexibility and protection that we're all in whatever country we're working in looking for.
Yeah, of course, Jessica.
Thanks. Sorry, just jump in. No, I wanted to make 3 points, especially in this contrast of UK and Australia. I think I was having this conversation yesterday as well. The conversation about pensions in Australia is very current in the media and in discussions amongst people, and the Australians are very acutely aware that they are saving for retirement and that they have this pension pot. Whereas in the UK, they've kind of been auto-enrolled, and a lot of people actually don't even realize they have a pension pot. And I wonder to what extent this plays into their decision at retirement and the decision to take a lump sum, because if you don't know you have this savings for retirement, and then you're like, wow, I suddenly have £200,000. I'm going to take it. Of course you will. So I think we probably need to work a bit more at having pensions be a subject of social discussion, and making people aware that they are saving for retirement and the importance of that. Continuing in the comparison between Australia and the UK. You mentioned the reluctance of the Australians to draw down the money, and I think part of this is due to the fact, and this is also the case in the US, that there is a required minimum distribution that people have to withdraw in order to, at a certain age, in order to make sure that they are taking this money and not using it solely for the purpose of tax benefits. And we observe this both in Australia and the US. There is a tendency to gravitate towards that specific reference point, because that's the reference that people have in their mind. So it becomes kind of the default withdrawal rate for individuals. It's a behavioral bias because they have this reference. And some people actually take that as the recommended drawdown rate. So this is another problem that we have to make sure how, to the extent that these required minimum withdrawals are in place, we need to be very careful about how that's communicated and framed. And then a final point, going back to how we need to make sure that the rules we put in place are going to be okay in 20 years and the long term. And some of the answers to the initial quote from Francois saying, oh, we don't need to think about this yet. I fully agree with Francois that we definitely do. If you don't put something in place now, once you get there, it's going to be much harder to put something in place. And we've seen this a lot in Asia. So for example, Malaysia has a very successful public provident fund. So employees are obliged to save, and it's been going, I don't know, 20, 25 years now, and they haven't put in place anything for retirement. So people take their money as a lump sum. But now people have enough money, and they know they need to promote income products, annuity products. It's politically impossible to implement, because once you give flexibility, and I suspect this will also be the case in the UK, you can't take it back. It's much easier to put something in place, set this expectation already. You should probably be taking an income, and this is what we're planning for you to do. And then if you need to add more flexibility down the line, you can add more flexibility, but you can't say you can do anything and then introduce less or take that flexibility away. So I think that's very, very important to have in mind this when you're even starting to think about design.
Yeah, because I think at that point, the identity of the product has already shifted to, asset management and investment, and something that is individual capital. I just wanted to switch tracks and link this decumulation panel to bigger European discussions. Carine, at the risk of front-running the next panel on the Savings and Investment Union, I think there's also a case to be made that there is a link between, decumulation and the types of investments you do, and the European Commission wants to see more investments in productive investments, more private assets. We've already heard. Do you think there is a link with decumulation and pension decumulation design?
So this is something that is not yet in a big discussion, I think, on SIU, of course, because well, we're all waiting for what the Commission will bring in upcoming consultation. But actually, it's one that is key. So I think there is a clear link, because as we heard throughout the presentation, there are these two extreme: full annuitization or full cash. And of course, you can play with the taxation and try and incentivize people from one way to another, notwithstanding they understand the taxation system. And I do wonder, because, you know, the idea of SIU is really to promote the holding of illiquid assets. So, so first of all, in the context of auto-enrollment, assuming that you don't have this problem of small pots and people generally start having sizable accounts, these accounts towards retirement, I think what is important is from a scale perspective. So who, depending of who will have the responsibility for the choice, so be it the individual or the pension funds, for the role of these in the decumulation and payouts. I think what will be interesting is whether SIU could bring this idea of hybrid, possibly default, because if you extend the time horizon from, you know, full annuitization, that's it, I think, or full cash, that's it, you know, it's the end of the SIU from, you know, it ends on the day that people take their cash, right? So if you design some solution which are more hybrid, still leave flexibilities, as you said, Michael, for people maybe to take a little bit of cash, they still annuitize later in the future, that could be an incentive, and that's where I see the link. But we'll have to see a little bit more in the future how this pay out. And this will be important from a fiduciary perspective as well, because you know, if you look at the IOR2 directive, the prudent person is again accumulation, and then if you look at the rest on the decumulation, this is all about information you should provide to the members. So you know, we'll have to see if more on the there might be more regulatory requirements, for instance, leading towards that. And I mentioned IOP2, but it could be PEP. So because again, PEP decumulation, this was left because it's of course the big elephant in the room about, you know, taxation and different tax treatments. So so we'll have to see for the future. But I think for me, yeah, there is a clear link, and maybe our role is also to show to the policymakers and the Commission that it's important that they include this decumulation as part of the SIU discussion. And that's also where we will need to, because again, there are a lot of discussion about a long-term savings product, and we need to make sure that, you know, retirement income products are there, you know, for generating pensions. So, you know, making clear that, you know, when we talk about a retail savings product for the long term, it's not a pension. So when I started at EIOPA, again, I was looking at the French market, and I saw that, you know, a lot of the time, you know, life insurance products were sold as pensions, but in the end, you know, you can take your life insurance contract. So so I think it's also important for the messages to people. And just to go back on the previous discussion on, because you didn't give me time to answer, but so we discussed, you know, UK and Australia, but we also need to account for cultural differences, which can be also in the setup of the regulatory framework. So you mentioned that more and more DC pension savers in the UK will have to give their retirement income towards rental income. And Ireland is probably, very similar. But if I look at other countries, the share of housing might not be as significant. So I think, in all of this, all I'm trying to say is back to, we have a very diverse landscape. And when we design European solution, even for retirement income, we need to make sure that people's reactions and people's cultures towards savings might differ between countries and might also be on the place and the trust they place in state capital markets. So we really need to be careful that, there is no copy paste, of course, and that we factor in both this behavioral element, but also, financial incentives can work. So I think member states will have to really, think carefully about that.
Can I just come in? Because I think that comes back to the fundamental question, why do we care about decumulation? Why are we looking at it? If you look at accumulation in isolation, the investment time horizon is like that. If you then look at a vehicle or a savings vehicle from inception to death, the investment horizon is suddenly like that. And you can invest in growth-seeking assets, alternative asset classes, a lot easier if you're going to and through retirement. I'm really interested in the work that the SIU is doing in relation to liquid investments, private markets, this type of thing, particularly with the fiduciary duty angle. We did some work for one of our clients in the UK around fiduciary duty and whether it was reasonable to look at an individual's standard of living in retirement when looking at fiduciary duty in the accumulation stage. And our view is that it is, because there's no point in having a really good accumulated pot if when you come to convert it into retirement income, you're retiring into an economy that is got low GDP growth, stifled growth, poor access to services, poor access to infrastructure, which we're encountering in the UK. And I think that as fiduciaries, there is a responsibility to be looking at how that pension saving gets used in retirement and what it means in real terms to be able to extend the time horizon and really determine what your beneficiaries are getting from the contributions and the investment growth that they're receiving. And I think worldwide, there needs to be a far more holistic, strategic look at how investment leads to outcome based in the society, environment and economy in which retirees are accessing their pension savings.
Yeah, and on that one, I think this is a debate that's still yet to become, because I think communication on SIU is also key. So pension funds are not there to serve the SIU, of course. Yes, the fiduciary is really about making sure that people will have decent outcome in retirement. But of course, the ultimate goal, as you said, and I think that's something that I'm sure will come in a further discussion, is, we want our retirees in Europe to retire in a prosperous, productive, competitive Europe with good infrastructure, quality healthcare, because also with the aging population, we will have fewer younger workers. So we need to be productive so that those who are working, still make the economy prosperous, but also because there will be a need for more social care and medical care. So, so I think you're right. In that sense, this is something that still needs to be debated in the future.
I think all the members of Pensions Europe think it's really great to hear that pension funds are not there to serve the SIU. And the fact that I asked the question about the connection doesn't mean that we think there's a bigger role for the European Union to play in regulating the decumulation phase, just so that is on record. I wanted to bring it back to Geerke. I think we've heard, the issue of small pots, and that in the case of small pots, people aren't really interested in taking out anything other than a lump sum. If we can just turn it around, let's say we actually push towards annuitization, even of small pots. Wouldn't that make it more visible to people if there's proper communication that actually, what their money is worth in retirement is not so much? Or do you think in Romania there's other things that need to be done in order to grow the pie?
For sure, I would say the pie needs to be grown much more. So I think but that goes to the accumulation phase. So fiscal incentives to save. If we, Mr. Armeanu in his video explained, we have a fourth pillar, occupational pensions, but for the moment there's no fiscal facility for that. So the reality is that that pillar is there by law, but is virtually non-existent or really non-existent. There's no scheme operating in Romania. Pillar 3 has a tax deductibility, which has not been changed since the system was introduced, in spite of all the inflation. So at some point, you need, of course, to get the accumulation going. I think the second thing, which I referred to earlier, is the more you can make the payment phase or the legislation of how you organize these payments, if you limit it to just your DC pot, you're limiting yourself. And maybe that's a small pot, or the pillar 3 pot in the case of Romania, but I imagine in other countries there could be small pots as well. So to what degree do you allow for people to bring in other funds, bank savings, life insurance payouts, and how do you create a system where you can accumulate all those small pots that people have, so that the income that you show is actually a big one? Because in reality, if it's say, okay, in an absolute amount, but let's say in a percentage, this thing you saved is gonna contribute to 2% of your retirement income. Even me being mathematically inclined and understanding that if I add percentages, it adds up to a lot, you would still intuitively say, okay, then I'll take the lump sum. So I think there are various ways around it, communication and having some sort of advice, projections, people understanding how their money grows, evolves, and what it can do for them is important. But I think there's much more needed than that. So financial awareness is one thing, but we know fundamentally, and you can go into very research of neurologists, that our ability as humans to estimate small risk a long time into the future is just not very good. And even the actuaries in this room, if we would ask them to do it without having the mortality tables and everything there, they would probably make huge mistakes in their calculations, because we are just, as humans, our brain is not wired to do that accurately. So then we can be very, sort of ambitious and say, we give full freedom and people will understand that if it's 2%, doesn't work that way. So unfortunately, our brain, maybe we evolve over a number of generations to some bionic person with, but I don't think we're there. So I think there's more needed than just informing, because it's not the facts that in the end will drive behavior in all cases.
Yeah, maybe I can share a little bit, what was the challenge 15 years ago from personal experience, because I worked also to design a bit auto-enrollment, but I was sat in a room behind a screen where there were focus group to test the design of auto-enrollment and Nest, what was going to become Nest. And as you brought people eventually in this focus group to the journey, explaining, you will be auto-enrollment, you will get your employer to contribute, also the contribution from the state, etc. And eventually, as they got it, and they got past, the fact that, of course, they will get a little bit less from their payout, from their payroll, sorry. And then you got to decumulation. And then most people in the room said, but I don't understand. You just told me I bought a pension. So, and that was the challenge already, 15 years ago, that decumulation was going to be a huge, huge, huge challenge, because if you harness inertia, as you said earlier on, it will be double, maybe triple the challenge. So I agree, let's not underestimate that.
I think the small pots issue is one of the big learnings of the UK of what not to do, or what a good auto-enrollment system inadvertently does. So the average UK worker is predicted to have 8 different pots by the time they get to retirement. If you take each of those pots in isolation, you're going to take the lump sum, because looking at the pot, you say it's small enough, I'm going to take the lump sum. You amalgamate them together, people wouldn't take the lump sum because together it's a far larger pension saving that merits some form of retirement income. And so there's a huge focus now in trying to consolidate and amalgamate those small pots to remove fragmentation in the system, but also give people a far better idea of what they've got in terms of their retirement savings. So in the UK, pensions dashboards are coming in, far clearer digitalization of what people have. But I think the small pots issue should never be forgotten of what an auto-enrollment system can do unless there's a degree of forethought on how to manage that type of issue.
Yeah, I agree that the dashboards are going to be a huge help, or the pension tracking system, EIOPA terminology, are going to be a huge help in getting people to understand the value of income, because already well, the small pot issue already, it allows people to see all their pots in one place. One of the reasons or in Australia, the dashboard actually allows people to consolidate all of these pots automatically. So it's really one of the objectives that they have with this dashboard. Not only to allow people to see them all together, but to put them all together to make management more efficient. But another big value of the dashboard is converting, as was said, that it's very difficult for people to understand how much income a pension pot could actually finance. And so one of the added benefits of dashboards is actually doing that conversion for them and already communicating how much income. So what does your savings mean in terms of income, and getting people to think about income and not a pot. Because if you do have like 500,000 at retirement and then you get told, yeah, but that means you can only have 1,000 per month, people are going to be like, no, that's too little. That means nothing to me. So I'm going to take the lump sum. So already we need to start communicating in terms of income rather than just showing people the pot size that they have. But there's also the flip side, and we had this discussion in Spain when they introduced the new occupational reform, because they were developing a digital platform just for this, but it's going to be super tiny at the beginning. So we said, yeah, it's really important to communicate in income, but when you're communicating income on $1,000 or €1,000, it's going to be very tiny, and that actually could risk backfiring. And people say, well, what am I saving for? It's not going to give me anything in retirement. So there is this balance to be found, but I think it's important that I think the dashboards will play a really big role in helping us get to this income mindset.
I do want to open it up to the floor. We have time for one or two questions. Chuck?
That's pretty efficient. Thank you, Liam. Is this better? Oh, this is better. I said, thank you, Liam. You knew I was going to ask a question. Let me share with you what happened to me 2 weeks ago. I was at a lecture from Yves Stevens, who has also addressed this conference previously. And we were debating the lump sum payment in the Netherlands. And we've been discussing that topic in the Netherlands for over a decade. And the state of play now is that we postponed it for another 2 or 3 years, but it is still in the air, driven by what has been discussed by you. People need flexibility. It sounds all good. And he said, never do it. Never do it. Because in a typical DB system and in a well-structured DB system, people look at NDC, they look at the pot of money, but it is with the aim to be distributed over the rest of the lifespan. The moment you introduce the lump sum element, it is regarded a personal financial possession, and it is mine, and I'll take it. And you win your pension system with the aim for rendering cash flows over the remaining lifespan. So don't do it. And he said, well, you see it. It happened in the UK. It started with 10%, goes to 25%, goes to 50%, goes to 100%, and there you go. And it changed my view on the relevance of lump sum immediately, quite drastically. In the new pension system in the Netherlands, we have this variance on the theme of high-low. You can choose for a number of high payments and then a consecutive number of lower payments. That is probably then a better way forward. Any reflection on this one?
I feel obliged to because I actually mentioned, oh, the Netherlands is moving towards more flexibility, so I should probably respond to this point. That's true. I think, but also I think the Netherlands might be coming from a different place in that you've already established this cultural awareness and understanding that a pension is for income. So maybe that effect will be not as strong. I'm not saying it won't be there, but maybe not as strong because people already see their pension, as income. But I like your idea of maybe restricting the way you can take that lump sum out. I think maybe there's something to be thought about more there. But I think some more flexibility could be called for in how payout is designed to adapt to different situations in retirement. And context matters, starting points matter. As Carine says, we can't copy paste because something that works in one country is not necessarily going to work in another. So lessons to be learned, but also things to think about how we can go forward.
Yeah, if I would add a bit to that, I mean, being Dutch, growing up in Holland, you're safe for your pension and you expect that to be a lifetime income. Then I started working in pensions here in Romania, and suddenly the concept, for instance, is a concept we didn't discuss about, but of inheritance came up. A Dutch person would never think that their pension pot would be inheritable. That's kind of almost anathema to the whole idea of saving for your pension. In CE countries, people actually don't understand that it's not inheritable if you make a lifetime annuity or something like that. So again, I think I agree. It's very much where the starting point of population and public opinion is where you, so even conceptually, I would agree with you with my Dutch background. I think the reality on the ground here is if you would try to sell that idea, it's probably not going to fly. You probably need to have some sort of lump sum, high-low, whatever, but you need to have probably that much more flexibility for people even to be willing to have the trust in the system and to be willing to engage with the system. So I think it's a very cultural element there.
I think I agree. I think it's very dependent on the jurisdiction that you're dealing with. In the UK, going from compulsory annuitization to freedom and choice, there was a huge risk transfer to the individual, and suddenly the individual is on risk for a whole manner of things, longevity, investment. So then to take away the lump sum and that freedom with that risk that's heaped on them through the system, I think would be difficult now where we are. That's not to say jurisdictions that haven't had that huge switch to flexibility couldn't and shouldn't be looking at ways of limiting lump sum. But I think it has to be jurisdiction dependent, because I think in the UK, if we suddenly decided you can't take any form of lump sum, that would be a really difficult message, given the risks that individuals have taken.
One final question, and I see Anne raising her hand.
I don't have a question, but I want to give the Belgian perspective on this discussion. As the Romanians, we also have the how do you say, the behavior of taking up a lump sum and preferring a lump sum. Don't touch my money, it's my money. So it's difficult to get them to an annuity payment. And first of all, I have to say that our pension market is still very immature. So for a lot of people, the pension pot is still very low. So pension providers don't invent innovative products because it isn't worth it yet. So at the one side, you have 95% of the people who are taking their lump sum because they indeed can give it to the children, because they have set aside a part of their wage to save for retirement. So they take it as their money. So they want to have their flexibility, but also because they don't trust the government. Taxes are going up. Belgium needs money. And of course, that's much easier with an annuity payment than with a lump sum payment. So I think they have a responsibility as well.
All right, I think that adds yet more national complexities to this discussion. So I think we're going to stop now. Otherwise, you know, we won't be able to see anymore the solutions, because I think that's what I would take away from this panel, that, you know, yes, there are challenges and a lot of trade-offs, but there are also solutions, you know, in communication. I heard, you know, that in the UK, more emphasis is being put on guidance. In the Netherlands, we're working on the same choice guidance. So there is a role for the pension sector to help people understand their pension, their benefit, or their annuity, or whatever. And I think, you know, it is upon us to develop that further into the future. So with that being said, I want to thank the panelists for moderating themselves half of the time, which makes my job very easy. That's always good. And you all for listening. We're now going into the lunch break and returning at, I think, 1:40. All right. Thank you.
So good afternoon and welcome back. Thank you for coming back so promptly after lunch. We now move on to the afternoon's proceedings. We now move on to session 2, Building Bridges, the Pensions and the Savings and Investment Union. Before we move on to the panel, which I will be moderating in about 20 minutes or so, we are delighted to welcome Tilman Luder from the European Commission from Brussels. He's now appearing on the screen. Tilman Luder is head of the unit for insurance and pensions at DG FISMA. Prior to that, he was head of securities markets also at DG FISMA. So Tilman, welcome. Hopefully you can see us. We can see you right now. Tilman, you will be joining us on the panel. I understand. So when you finished your remarks, if you just give us a couple of minutes, we will, the panel will assemble on the podium here and we will continue the dialogue. So Tilman, thank you for joining us, and I'll hand over to you.
Yes, thank you very much. I hope you can hear me okay. This is the case. Okay. So I will be giving you a short outline of our sort of sub-chapter investments and financing of the 19 March communication, which sets out a bit the work program of this commission in terms of what we are trying to achieve in further developing the savings and investments union. Our commissioner has now put out this first sort of strategy paper. It's called the communication on the 19th of March. And you will notice that pensions figure quite prominently in this paper, both under the heading of retail investing and also under the heading of investments and financing. So you'll see that the goal of us looking at pensions yet again is a dual one. The first one is to sort of further develop supplementary pensions, supplementary pension schemes, the supplementary pensions sector as a whole, and I deliberately don't make this distinction here between various pillars. We're just talking about supplementary pensions in a rather sort of more global way, as being the non-statutory pension sector. So developing that sector is goal number one, and goal number two is to promote investment in equity and other alternative asset classes. So investments also in private markets is a big priority for this commission, because a lot of the promising segments of the European ecosystem are actually private markets. There are then the actions which I shall just briefly set out. Best practices for auto-enrollment. That's not a piece of legislation, that's just recommendations. Likewise for pension tracking and pension dashboards, that will take the form of recommendations. And then we have the two legislative aspects of this reform, which is the EIOPA review and the PEP review, PEPP, private pension product. And those will be done in an accelerated time frame between now and the end of Q4 2025. In reality, that means that probably the results of these reviews and accompanying proposals will have to be tabled for adoption by our college in November 2025, which means that we will be working against a very accelerated schedule. This means that, so tentative planning to get all the logistics out of the way up front. This means tentative planning that we will do a consultation on some targeted aspects, which we will be deciding on soon, what those targeted aspects will be. We will doing a consultation on those targeted aspects in May. It will be an 8-week consultation. And in the middle of this consultation period, we are also planning to organize another forum, a workshop, a stakeholder forum, where the topics of that consultation will be discussed with everybody. So May will be the sort of first 4 weeks of the consultation. Then we will have some form of stakeholder engagement with a workshop end of May, beginning of June. And then in June, you have, of course, the second 4 weeks of that consultation. We will then assemble and the results, present them as an impact study, and the college and our political masses will then decide what kind of measures, what kind of reforms will be tabled by the college, in my opinion, already in November. So that's the logistics of the whole thing. As I said, we have the supplementary pension sector and further development of it as a main goal. And I think as part of at least of the EIOPA review, there will also be a focus on investment mandates. You've seen in the recommendation, there's a lot of talk about equity investments, patient capital, private markets. How can we foster a further engagement of the pension sector? And this is, again, all of the supplementary pension sector. How do we foster a further engagement of this sector with the European economy? There's a slight emphasis here on the European economy. It's not specifically said in the paper, but as soon as you talk about private market engagement, there is a certain expectation that asset allocators, asset managers, pension consultants will recommend strategies which involve private markets with which they're familiar, and private markets which they're familiar tend to be local markets. So there is a slight sort of emphasis here on these private markets, also because it's believed in terms of expertise and familiarity that trustees and their advisors, or the outsourced managers, will favor those markets which they know best. And these are European markets, these are even local markets. And we are trying to foster this investment culture by the supplementary pension schemes, which emphasizes also a bit the European angle of the investment portfolio. Now, in the two legislative things, just very briefly, and I think this is maybe a debate then that we can have afterwards on the panel. There is PEP and IORP, so let's start with PEP. I don't think I need to say a lot about the PEP because we've had very extensive recommendations how to make the PEP more attractive from EIOPA. Obviously, all of the EIOPA advice will play a role. I want to just highlight that EIOPA is very much focused on looking at value for money, maybe as a supplement or even as an alternative to the cost cap. We hear that the cost cap as such is not actually the problem. It might also be more an issue on how you calculate the component costs of this cap. That we are very open to look at both alternatives, either keeping the cap but maybe changing some of the components of it, or replacing the cap with value for money considerations, or supplementing the cap with value for money considerations. I think everything is open to debate here. Other issues is that the PEP should also be a scheme where employers can co-finance, or where employers can participate. EIOPA is very strong on this point, saying that this is a decisive issue in terms of increasing attractiveness of this vehicle. Transfers from other pension products into the PEP is also mentioned by EIOPA. And then obviously a totally, in my mind at least, somewhat alternative approach is to say that maybe we shouldn't have a PEP as such. We should just have a label whereby many supplementary pension products which exist can comply with that label and achieve a certain amount of standardization and therefore cross-border attractiveness through this labeling route. Everything is open here. The PEP has not been a big success. I don't think anybody can claim that it's taken off like a rocket. And we would approach this rather modestly, therefore, to say that nothing of anybody's recommendation should be a priori off the table, because the council, so the member states, have actually said that they expect us to submit improved version of the PEP by the end of the year. So this is no longer really an option to look at the PEP, and this is also no longer really an option for us to determine the timing of any further engagement with the PEP. The council, the member states have actually said, we expect you to propose improvements to this vehicle by the end of the year. So we will obviously have to table something on the PEP. That's no longer an option to deal with the PEP or not. It is just now what we will table and what of the EIOPA recommendations we will integrate into this PEP reform. But for those who care about the PEP, we can obviously discuss this in greater detail when it comes to the subsequent panel. We then go to IORP, just also to conclude this opening. In IORP, there are mostly the EIOPA advice mostly is about issues of governance. And in the recommendation, I think the scope is very much because many other parts of the Commission are also looking at pensions quite carefully. So the scope is a bit on private equity, on venture capital, on private markets. I can explain that this scope results out of the fact that the Commission is also obviously very engaged in fostering a research and development culture in the European Union, and also bringing research and development results to market. We have a DG, which is even research and development. So a lot of this is also because our colleagues believe strongly that we have to create a better European ecosystem so that good ideas, which are abundant in Europe, will actually be financed and brought to market. So this is about startups and scale-ups, but this is also At least that's the FISMA view. This is also about lots of other companies that are not publicly listed, but that are investment targets, and also maybe in terms of loans. We are not saying that all of these private markets should be equity financed, and that pension funds should all just go into the private equity. But there are also a lot of these private assets which are loan financed, and that is also why there is lots of debate about securitization, that we should have securitization vehicles which are very much focused on also the loan portfolio to private companies, and that these are also assets which the pension sector should consider to diversify, to have a broader portfolio, and most importantly, to enhance returns for the beneficiaries, because that is an important issue also for EIOPA. That's again why there is a value for money debate for supplementary pensions. Do they produce value for money? What hinders even more sort of return, even better value for money? And there, the usual analysis is there is a lack of scale. And if scale would be higher, there would be also the opportunity and the ability to broaden the portfolio exposures. And with a broader and a more diversified portfolio, the expectation is you will also increase returns. So the IORP debate is mostly about strengthening accountability, strengthening governance, so that these IORP operators are better equipped to exploit investment opportunities in those alternative assets. There is a lot of small print which we can discuss in this, but these would be the sort of main lines of that reform. And with that, I shall conclude and look forward to the subsequent panel. Thank you very much, and thank you very much for the invitation, and of course, apologies for not being able to come, but as you see, we are very busy in preparing this agenda, and the preparation of this agenda also requires preparing lots of documents, because it's not just a consultation that we have to do. We have to have a call for evidence. We have to launch all kinds of impact assessments. So therefore, we are quite busy now producing a lot of preparatory material, which has prevented me from participating in the conference. Thank you very much.
Thank you very much. Could I now invite the panelists, who I think are all in the front row or very close, to come up? We currently can't see Tilman Luda on the screen, but hopefully he is still actively participating by listening. So we will bring back Tilman Luda back into the conversation. I'd like to thank him for setting out so clearly the different aspects of the SIU that his unit are currently working on, and I think it gives us some very interesting food for thought to continue the discussion. And yes, here we have him back on the screen. So Tilman, we can see you now. We're going to structure this in hopefully quite a straightforward way. We will obviously reflect on some of those aspects around the consultation on IOP in particular, on auto-enrollment. We will look at the supplementary pensions aspect of the recommendations. We will look at auto-enrollment, as I mentioned, and we will look, I think, in some depth, hopefully, at what's termed as productive investment, productive finance and private markets, the opportunities, but also the barriers that our panelists are facing. But first of all, I'd just like the panelists, who I will introduce one by one, just to reflect on the supplementary pensions and savings situation from their particular national perspective, because of course, in building up the overall EU picture, it's unavoidable to look at the national peculiarities in the different member states of the different setups, which will obviously provide tailwinds in some cases and headwinds in others. So sitting immediately on my right is Grégory Mirou, who is Director of Employee Savings and Retirement at RFC, which is the French Asset Management Association. There have been quite a number of developments in France in recent years in terms of implementing the EIOPA directive that has changed the landscape of supplementary pensions and savings quite a bit. Could you outline what's gone on and what your starting point really is in this debate, and then we can go on to what France can offer perhaps as a model for other countries.
Well, thank you, Elaine. Hello, everybody. Yes, in France we had an important law which was passed in 2019. It's called the PAC law, and it reframed how works different retirement saving products in France. And so we had individual products, we had occupational products, and so this new framework with PACT permitted to have a global approach through on these products and try to give a new impulsion to them. And so today the last figures we have on these products set out value over 100 billion euros. So in five years, which is promising for the future. And today, the debates we have is how can we make available these products to more savers, because we have individual products which are often used for within a wealth management, and we also have occupational plans in France, and we have one which is called the PERCO. PERCO, it's a collective envelope which is designed for retirement in the companies, and it works very well because this envelope is linked to profit sharing systems you have, gain sharing, profit sharing schemes, and voluntary payments, which can be done by the employees, matching contributions of the companies, and all these different inflows can go in this retirement scheme and be used on a long-term perspective for investment and to be used at retirement as a supplementary retirement savings capital. And so today, the main discussions are how to equip more salaries and how are these investments used to finance the economy. And on this, when we see the example on France, we see that a large part of the savings of the investment go to stocks. Recently, last year, we had a new law, which was called the Green Industry Law, which provided a part of private assets which can be used in these envelopes. And so now you have a part of the payments which are made in the schemes will go through. Part will be invested in private assets, private equity, and this within a guided management solution, what we call life cycle management, and it's the default option of investment which go in these different schemes. And so the employer, the saver, has always the choice of what he wants to do with his investments. But if he does not make no choice, then they are invested in the different profiles. Here we are.
Thank you. Can I just ask you one quick supplementary question?
Yeah.
And that is, what is the coverage of supplementary pensions within the workforce, and how has that increased since the implementation of the PACT law?
So when we figure profit sharing in France, we have a legal obligation which applies to all companies over 50 employees to implement profit sharing plan and employee savings plans. Okay, so all the companies beyond 50 employees. That makes it today all the big companies have offered to their employees such schemes. The challenge today is to address SMEs, small companies, and in this respect, a few legislative measures, a few legislative provisions have been taken to address more companies. Namely, the last law is for companies over 11 employees. So that's it's vast, much faster than the previous obligations which occurred on this. But it's the real challenge for the future, how to equip more companies with these schemes.
Thank you. Thank you very much, Gregory. We'll now move to Beata Petri, who is Head of Pensions and Benefits. Turn this on. We now turn to Beata Petri, who's Head of Pensions and Benefits at BASF in Germany. BASF has a long and storied history in, like some other corporates in Germany, long and storied history in pensions and benefits. So I'd like to ask you what it is that you do. You run a large Pensionskasse which has quite sizable assets, around 10 billion, I think, and you have a very large workforce. So what do they experience? What do they get from their employer?
So first of all, in Germany, we do have 3 pillars as pension system. One is statutory pension pay as you go system, having a minimum level of the retirement, the pension of 48%. The new government, which communicated the treaty, the new coalition treaty yesterday, they fixed the minimum level on 48% until 2030, which puts the pillars 2 and 3, the occupational pension system and the private pension sector, under pressure, because we know that 48% of the pension level does not work for having an outcome in the retirement phase. So we need pillars 2 and 3 in order to have supplementary pensions. And as an employer, we do have our Pensionskasse since 1888. So we have a long tradition in the chemical industry, and we have a long tradition within BASF for our Pensionskasse. We have 60,000 pensioners who get beneficiaries, who get pensions from us, and we do have 70,000 active people or members who expect to get a pension from us, and we are in the responsibility to do this. So what are we seeing is the demographic shift, and we need a new model, or we need the possibility to invest, and we have strong regulations in Germany. As a Pensionskasse, we are regulated by the financial supervisors BaFin, and they really have a tight frame on us. So we have to have our we need to have our investments at place in order to be able to pay out everything we do have at every moment in the lifetime, which is not on every day, so which is not state of the art. We know exactly when our members do get pensions, so we can have a plan, and we can have a real good plan to invest and to get the profit into the system in order to have an attractive system. However, the regulation put on us, it's like they are stopping us in doing this. So this is some kind of problem we are facing. What we are facing in Germany is the fact that only 53% of our of the whole people do have an occupational pension scheme. and they take part. So which means, and this is stable over the last years. So what we are looking for in Germany is a way to enhance this. The government, they placed the so-called social partner model, which is a new model in Germany since 2018. In year 2025, we have 4 models in place, so we are slowly taking up speed. But it has no guarantees in it, which is a completely new aspect for the German public, because we are really driven by guarantees. If you ask a German what they want to have security. So like saying you have no guarantees in your pension system is like, ooh, this is a red flag for me. Yeah. So this is the kind of, you have to communicate really responsible, openly, and you have to be very clear about what you are doing and what you are not doing, because we're not risking, but we just want to have the possibility to invest attractively.
Thank you, Beata. Could I just ask you one individual question? So 53%, so that's a 53% take-up rate. Is that just in Germany or across the world? And what's so unattractive about your pension offering that only half of the people actually want to take it up?
This is I think, 53% who is not taking part. These are the low-income earners. And we do have ideas how we can rise up the number of low-income earners in the system, like having them a tax support for employers who offer occupational system for low-income earners, so that they have occupational pension scheme in place. We have small and middle sized companies that don't take part in the sector of occupational pensions. And these are the 2 main points, or the 2 focus points I see for rising this quota.
Right. Yeah, thank you. We'll come back to that, no doubt. So, do you want to come in now, or we'll just continue?
Oh, maybe a very quick reaction. Regarding investments, there is always a debate where we will have between returns and security.
Yeah.
And it's quite difficult to have both. You can have full security on your savings and full returns where the risk you're going to take. And that's why maybe the best thing is the freedom of choice, which can be given to the saver between guided or a guided solution, which can offer him some specific components in his investment towards maybe more security. And for those who want to have to take risks, take a longer time and be more investment with less security guarantees.
Yeah, go on. Why not?
That is a very interesting statement. Taking a look at it from a bit of an academic perspective, you can only come to a good pension, whether that be a nominal pension or a real pension in real terms. You need premium. You need risk in order to get return. So out of a Dutch perspective, the German attitude of taking very limited risk is something that is in the Dutch context being awkward. You need risk. But to put that risk at the individual, there's a lot of academic know-how that individuals tend to take a modest amount of risk. Individuals do not take enough risk with regard to their long-term pension aspiration. So leaving that at the individual, probably not a good idea. When I take a look at the Dutch environment, that those risk decisions, these risk return decisions are taken by the board of pension funds, listening carefully to their participants, but ultimately they decide on the risk, and so ultimately they also decide on the return, if it works out well.
I'll just stick with you, Jacques, if we may, in the opening round. Then, just to what really the first question was, what's going well in the Netherlands. So we know that a lot of things are going well. We know that you have within your framework, in some aspects, quasi-compulsory system. You represent a different group of at SPMS of of physicians. How is it going for them, and what's your top line take on this?
I thought I was last. Sorry. I was. The Netherlands has a very widespread system. I yesterday discussed this with my colleagues, and I said it's the second pillar started from the end of the Second World War, and then he said Jacques, ABP, the civil servant pension fund, started 100 years ago. So building pensions is a social phenomenon that is deeply rooted in Dutch society. We have, as earlier indicated, we have a typical three-pillar system, as is also advocated by the OECD. So the first pillar is this typical pay-as-you-go that is contributing to 12 to 15,000. I don't know the exact amount. It's a little over €1,000 a month for a couple. It's up to 23,000 euros. Then we have the second pillar, and the second pillar in the Netherlands is really very widespread. And that is a typical paritarian structure based on agreements between employers and employees. And that, well, we saw that in the pictures earlier, has contributed to an enormous size of 1.7 trillion assets under management that were billed by premiums paid jointly by employers and employees. And the third pillar is the voluntary element based on the fiscal rules that are now restored, to the sense that in the second and the third pillar there's a certain amount of room that is limited to an income of roughly €140,000. But premium to get to 70% of that is it can be deducted from your income. So fiscal stimulus, the legal capacity to build pensions in a fiscally friendly environment is a vital element. Another vital element is, as I earlier indicated, the fact that it is so socially well embedded. It is almost a normal part of a labor contract. Where does the Dutch system? So I think the Dutch system is contributing a lot of balance to our society. It is also a very professional environment where we indeed take risk in order to come to a good pension. So of this 1.7 trillion, 30 to 50% are in the risky element, in the risky asset sphere. Where does it? So I think all in all we are very positive. I'm very positive on the Dutch system, and if I were to give an advice to Tilman, it will be start with it as we have started with the system at a certain stage. Where does it not work properly, and that is the relatively young development of a lot of self-employed people would tend to be a bit underinsured for disability risk and take provision for old age as something that they're going to do in the future. And they do not tend to do it. So there the system is failing, and we debate in Parliament, but in the whole society, how we deal with this blind spot which is there in the system that is for the rest working very well.
Thanks. So a lot of it working very well, but obviously good to highlight the bits that do need improvement, including the self-employed, I think, and coverage there. As you move to a new system in the Netherlands. So we'll be coming back to many of these points, but last not least is Marius Radu. He is a board member of the Romanian Association and CEO of Carpathian Pensions. So we've heard a little bit this morning about the position of the Romanian second pillar pension system, the stock of savings, and the benefits to the wider economy. But there is room for improvement. So can you give your opening outline of what's going well and what needs to be done.
Yes, thank you very much. Indeed, my colleagues talked before about the Romanian pension system. Looking on the right and talking about thousands of billions, looking in the left, talking about hundreds of billions. It's quite tricky to say about the fact that we manage above 30 billion euro, but looking back in this less than 17 years actually of contribution seems a good start for the pension system in Romania. And this is based on the compulsory contribution within the Pillar 2, where we have more of the assets collected there. And due to the fact that we are facing several challenges during this short period of time, but was no time for boring for us as industry in last, I think last 16 years out of 17. We have some challenges each and every year. We did good result. We perform well. We have a good return for our clients, and on top of this, we succeed to invest almost all of our money, more than 95% in the real economy in Romania. We sustain the stock exchange. We have probably 40% from the free float there, and we are the one of the main buyers in case of IPOs and in other cases, but we stay a little bit away from the so high risk. So we are looking also on bonds and on fixed income instruments, and from this perspective, we are the second largest buyer of the state bonds in Romania. So we sustain overall the Romanian economy. And in the same time, we are looking at our members to have a good return for them. We are not in close to the payout phase, but we have to think at the payout phase. And I was a little bit shocked by the challenges that advanced countries have in relation with the payout phase. So probably will not be away from these challenges, of course. And it's very good moment to learn some lessons from this discussion as to be prepared, because at the end the clients has to have the best result for the pension, because this is our social role mainly. Yes, with regards to Pillar 3, we have some success there. The Pillar 2 in Romania is not comparing to Netherlands. It's just employee contribution, part of the social security contribution. The employer doesn't contribute. On the Pillar 3, we have the opportunity to have contribution from both, but it's voluntary, from the employee and the employer. But unfortunately, so far, it's not so well developed. If we are talking about the ratio between the clients in Pillar 2 and Pillar 3, we have a ratio 1 to 10. If we are talking about the assets, we have a ratio 1 to 30 probably. If it depends on what value of the price we are looking at this from yesterday or from last week. but at the end, this is the ratio, and it's clear that here it's a large room for improvement within what means Pillar 3 and the voluntary pension to be more attractive for the clients. And here there are some things that can help in my opinion. So even we start 17 years or 18 years ago, actually, Pillar 3 was starting 18 years ago. There is still paper-based process mainly, so digitalization can be or can boost this process. And of course, in voluntary contribution, tax benefit, it's the only promoter at this moment actually. And we saw that the level of the contribution on the Pillar 3, it's very close linked to the level of tax deductibility. So we have 400 euro per year tax deductibility, the average contribution in the pillar 3 is 400 euro per year. So it is very linked to this.
So we've heard from Jacques as well the importance of a fiscally beneficial framework. You're emphasizing that. I want to ask about political stability and political backing, because any system needs continuity. In Romania, are you confident that across the political spectrum, you have support for the supplementary retirement system as it is?
Yes, so even it's hard to say, but in this moment seems to be the most stable relation between the pension business and the government. In this respect, of course, it's as the system was starting in Romania in 2007 as precondition for adhesion to European Union of the Romania. So a small hint will help us to make a step in front of this. So now the intention of Romania to adhere to OECD means that we have important help from this perspective, and some directions and guidance from the OECD was taken into account by the government, and now we have some ordinance within analysis for approval to wide the investment universe, to stabilize a little bit the business and to make Pillar 3 more attractive from this perspective. In the same time, there are some measurements with regards to increasing the level of deductibility. Hopefully will be in place, even we are not on the very good position from public deficit, and it's challenging from this perspective, but the steps are very good and positive at this moment.
Thank you. Yeah, we'll move on now. Tilman, thank you for holding on in there. We'll come back to you in a moment. But what I want to address now is a central part of what's been raised in the SIU communications, and that's around auto-enrollment, as Tilman mentioned. So the next question is, I'm going to do a slightly different order just to mix it up a bit. I'm going to start with Beata. I'm going to start with the question, really, if auto-enrollment were introduced in Germany tomorrow, would it work? And that's against the backdrop of several government initiatives over the last, I think, well, quite a number of years to promote the social partner model. It hasn't worked. So do you just need to do something a bit more radical?
I don't see auto-enrollment as per se the best way to get people into the occupational system, as we do exactly see where the problems are, as I described in the low-income earners and for the small and middle-sized companies. I think that we should support and help these target groups or the companies into the system, and making it easier for them to take part. So there are good ideas on the table, which we had already in a law, which wasn't realized due to the breaking of the coalition last November, to how to support low-income earners, because they have a very tight budget and they can only spend their euro once. So they need to really think where to put their money, and if the employer is going to support the occupational pension scheme there, and so both have something out of it. So this is the first thing I would do, and the other is how to get smaller and middle-sized companies into the game. Sometimes we have the collective agreements with the social partners. In the law, it was already in place that we open it up for the companies that are not part of this model. So a little bit more flexibility in order to get them so that they can take part in the existing social partner models without getting into the union or into the collective agreements themselves. This would, I think, get a push into this target groups.
Thank you very much. Thank you very much, Beata. I'm going to turn to you now, Gregory. Essentially, same question in the context in France.
Well, we have two aspects. The first one is to how to improve the the savings, the revenue that an employer person will have in retirement, and on the other hand, how to invest more to foster investments in Europe and to build and enforce a better European economy. And in this respect, when we see what happened in the United States with 401ks and the RISA regulations and how it worked over there, we see that auto enrollment, at least for workplace savings, is a powerful means to channel savings in the first hand, and afterwards the question is, where are these savings going to be invested? And so first of all, we see, for example, in France, I was talking about the PER, the fact that when it's implemented in a company, we see the real use and the fact that with tax incentives, with matching contributions, with voluntary payments, but also profit sharing premiums, which can be earned, we have many ways to guarantee inflows in these products. And we are thinking about, yes, auto enrollment. It was a larger reflection about Europe, and I heard in your introduction the idea of a label which could give a global framework for all these products, including retirement products, but all existing national products. An auto enrollment, at least for workplace schemes, could be a way for many households all over the European Union to finance future and to create what would be a virtuous circle to stimulate the wealth of European economy through better investments and larger investments and household investments directly in the economic fabric. So that's to be. So yeah, auto enrollment should be
could be one part of that, but also it's making the products and the setup attractive.
Yeah,
and that will also crowd people in. I'm guessing.
And when we say auto enrollment, there is always the option to go out. So it wouldn't be a deep an obligation for the employee. He would always have the choice, freedom of choice, not to benefit from the system. But if he doesn't do anything, he's enrolled within the scheme.
Marius, the same question. So auto enrollment, will it work in Romania? Would it work in Romania?
Yeah, it's a very challenging question. Yes, having experience from the compulsory pension pillar 2, seems that auto enrollment will have an effect on saving for the clients. We, as a pension fund association, have a study, and we saw that for many of our clients, the saving in Pillar 2 is the only savings that they made for their retirements. It doesn't have any kind of other savings, and as also Helke mentioned, the pension capacity provided by both Pillar 1 and Pillar 2, it's at about 40% from the last salary, and desired percentage, it's 17–80%. So it's a big gap there. So I do believe that auto enrollment, based on the right promotion and having behind this not financial education, I think more than this risk literacy in place for make people to understand that this is something saving with pushing can be helpful. Of course, that opt-out options has to be there, and we cannot force them to contribute more than they can or they want. But I think that would be beneficial if it's designed properly. Because if it's not designed properly and behind this is not linked between all the stakeholders, we can have the same effect like we have now in the Pillar 4. We have a law in place for, I don't know, 3-4 years. Secondary legislation, nothing happening because it's not linked to all stakeholders. We have no tax benefit behind this. We have no clear view on the lifetime of this product. We have no clear output for this. So yes and no. Yes, would be benefit to have this auto enrollment, but if it's not properly designed, a mechanism would be nice disaster. And I think that we do not have to do this because we really need to prepare our members for the retirement period. And even we are still in the accumulation phase, we have to help them from now, because everybody knows that the pay-as-you-go system will not be able to support the demography that also Romania is facing as a whole Europe.
Thank you. Jacques, so you have a good system. You have very high coverage in the Netherlands, which has come about organically over about 80 years through the social partner agreements. Could auto-enrollment, for instance, help plug the pension gap to help encourage take up in the final yards, as it were, the self-employed and those who aren't covered at the moment?
Okay. The Netherlands is just a very small country, and having very tight economic links with the rest of Europe. So please allow me to address this more out of a European perspective than a Dutch perspective. And I think out of a European perspective, I think we can now, I am completely with you, we can no longer rely on pay-as-you-go as the most prominent element of our pension system. So and the one country is further advanced than the other, but one way or the other, we have to increase funded pensions. That will limit inflationary and stagflationary risks in the decades to come. So for me, it is a complete no-brainer. Building and accruing funded pensions will also support the Savings and Investments Union, as it is now called, a bit more plain. When I do compare, and we all compare, the size of the European capital markets to the US, it's a factor 6. And we have a mutual obligation to do so. And out of a pension fund perspective, a bigger European Union would allow me to invest more in Europe. So let's accrue pensions, be it by auto-enrollment or otherwise. It'll support us socially due to the fact that we cannot rely on pay-as-you-go, and technically because a better capital markets union will be able to invest more and get our returns out of Europe, which would be a very good thing. Auto-enrollment in the Netherlands, a resolve for a problem that does not exist. I do not see how that could work in the Netherlands, except for the previous mentioned self-employed, one way or the other, that could be a way forward. And in the Netherlands, we judge that to be a problem, and we are discussing over years how to mitigate that problem. So just let's accrue more pensions, one way or the other.
Well, okay, that's a strong message. Tilman, can I bring you back? You've heard these messages. You've heard some reflections on auto-enrollment, which we wanted to discuss. Can I just bring you back for your initial reaction to what you've heard? And I'm just thinking that some of the tools that you have at your disposal are not the strongest because you can't create fiscal incentives. That's not your prerogative in the EU, and you're only making policy recommendations on auto-enrollment. What's your take on that?
Yes, thanks a lot. Can you still hear me? Seems not the case.
Can we bring the audio in?
Yes, because I can't see
Brussels. So perhaps we'll have to come back to you, Tilman. We can't. Oops.
I don't know whether you can hear me or not because I can't see anything on the screen.
Here we are. Yes, we hear you now, I think.
Okay, that's very good. No, I think there's a reason why auto enrollment is a recommendation. There are no sort of hard and fast legal rules on to impose this. There's also no real political willingness to impose this because, as the discussion in this panel has already shown, there is like the bottom-up approach. The Netherlands, if I understand, Germany is a bit in that camp as well. This has to be part of a collective agreement between employers and employees. This develops organically if there is this employment relationship. Maybe, as Jacques says, not so much if it's self-employed, so maybe that is a niche. So I will actually pass that message on to my colleagues who are looking at auto-enrollment. I also heard the issue that you can't just say auto-enrollment is good without specifying into what you actually wish to auto-enroll. So the recipient beneficiary of the auto-enrollment has to be rather clearly defined. So in that sense, I think it's quite, as you said, the European Union isn't going to make a legislative proposal on auto-enrollment. The European Union is going to say, if you are in a member state where the occupational system is relatively underdeveloped, if you are, if you like, in some sort of a catch-up phase, auto-enrollment might be a way to gain a lot of time. Obviously, if you are in a very developed supplementary pension environment, you don't need auto-enrollment, and you may want to choose auto-enrollment on a targeted basis for certain groups where you have no sort of established employer-employee relationship. You may also, that is at least something which I would like to throw into the debate, have auto-enrollment for very small companies who are not actually supplying an occupational scheme, but who would participate in a joint or in a pooled scheme. You could say, if you're an SME and your employer is not individually capable of running an occupational or workplace pension for you, but you may wish to put it in a pool. If that kind of would be given an impetus by having an auto-enrollment system, I think that might be an option. And I also want to stress what I think is important in this employer-employee context, and which was mentioned also by a French colleague, AFG. You actually have shades of gray here in this auto-enrollment debate. It's not just auto-enrollment by statute. Every employee has to be enrolled in at least one scheme. You have the sort of de facto auto-enrollment that your employer says, I'm setting up this scheme, either individually for me as a company, or if you're a small employer, I will contribute if you join this kind of collective scheme, and then you have the opportunity to opt out. That for me is like a contractual or almost de facto auto-enrollment, because given the inertia of most sort of employees or most people who will be invited to a system, could be a self-employed system as well, they will probably not opt out, and then everything is fine. So you don't need to actually force them in the system. I think a sort of contractual type of offer with a presumption that if you don't opt out, you have accepted, would probably be something that we would also be recommending as a form of best practice. But as I said, in conclusion, the European Union is not ideologically wedded to one way or the other of doing this. I think that's important. I think auto-enrollment is good if you are at the incipiency of a pension scheme, might not be as necessary if you are at a very developed level, but for certain groups, employees of SMEs and the self-employed, certainly if I would have my way, I would put in a bit of an encouragement for a contractually designed auto-enrollment scheme. Thank you.
Thank you very much, Tilman. So we'll now move on to the question of areas of productive investment, as Tilman outlined, ranging from taking more equity risk to taking more risk in private markets. So it's quite a wide spectrum of different asset classes that we might be looking at, and there might be different incentives and obstacles in different contexts to actually moving or allocating assets into these areas. This, of course, against the backdrop that I think many people are aware of, that there has been a gradual trend for corporates not to list, and the number of listed companies overall in the world has declined. Essentially, there are more opportunities in private markets, be that private equity or lending or infrastructure or real estate lending. So I'm going to start with Beata again this time, and I'm just thinking specifically in the German context, quite unexpectedly, German Pensionskassen have been given this opportunity to invest 5% of their assets, an additional 5% in risk assets as defined, with a specific sleeve for infrastructure. So with that in mind, how do you see BASF responding to that, the BASF Pensionskasse, and the wider German context?
Yeah, this came surprising in February to us, having the new risk quota from 35 to 40% and the new infrastructure quota of 5%. So we are very happy with this, but as it gives new opportunities, but it doesn't make this change is not the only one we need. What we need now is that BaFin, our financial supervisor, takes it into his or into their regulations in order to find pragmatic solutions and to bring it into the stress tests as well that we need to do every year. So as long as this has not been done, it's nearly not manageable to go into these new quotas. As BASF, we already do infrastructure like it is spread over the other asset classes, like hidden, like our hidden champion. We can now do it as a separate quota. But I see that the foremost thing we need is the BaFin supervisors in order to give it a pragmatic solution for Germany in order to have Pensionskassen to use it.
Great, thank you. Thank you very much. There are obviously different ways of implementing private markets, and studies show that there is quite a differentiated cost impact according to how you implement it. On the one hand, you could invest in funds in funds of funds. On the other hand, right at the other end of the spectrum, you could implement everything yourself. You could originate, you could co-invest. Most people don't do that. Most have some kind of combination, but the differential is very, very different in terms of the cost drag that you get. So I'm going to turn to the Dutch context now. What are you doing in SPMS in private markets, and in particular in your transition to a more defined contribution oriented system? Is that going to be more private market risk?
Okay, what an interesting question. As a mid-sized firm, 13, 14 billion, I would judge that there's almost no asset class that we're not invested in. We're not scared away by any means for illiquidity risk that is part of our business. Our duration is over 30 years long. So over the years, we have been investing in illiquid assets massively. When you were to compare the current asset portfolio with regard to the expected portfolio in the new system, I tend to think, I'm not 100% sure, but I tend to think we take a bit more risk than we already do. But if we were to compare the Dutch risk taking compared to Germany, even in the cohorts of over 65 plus, our risky asset is 55%. And how is that managed with the regulator? Yeah, that is based on ALM models, and they do not predict the future, but because it's always otherwise. But it gives you a sense where this mix of risky and non-risk assets will bring you over time with the long duration of our liabilities in mind. So we are illiquid and we will continue to be illiquid and probably to a bit larger extent.
Thanks for that context. Gregory, I'm just going to turn to you from the French context. So we have the issue in savings schemes and defined contribution schemes. How do you fit illiquid assets into that? It's liquid assets, ETFs and index investments work really, really well, and they're really cost efficient. But as I think the perspective of the Commission is, it's all very well to build up a stock of capital savings, and it's all very well to be taking risk. But if that risk is essentially going to be exposed to 70% to US equities, well, that might have two outcomes. One is that obviously it channels savings out of the European Union. Second is massive drawdowns that we've had in the last 5 days are not good for the confidence of savers. So that tells me that maybe a bit more private market risk could be quite good. How do you think that's the case, and how might it be done?
Well, from the French perspective, we have been working last year. I talked about it at the beginning. The Green Industry Act, which provided with new provisions in retirement schemes for a part of the payments to be invested in non-listed assets. What we believe from the asset management industry is that there is a continuum between non-listed and listed assets, between small companies and big companies. And we have to make Europe, how would I say, a good territory for companies to start, to grow, and to reach a very big size. And so long-term investments and investments in equity is good for this. And when we read the Letta report, the Draghi report, the Christian Noyer report, they all say the same thing, is that Europe needs investments. And so private equity also gives significant levels of return, not better, not worse than other types of assets. So this is important. There is this continuum. There is this need to finance different categories of different sizes of companies. And when we take the approach of, for example, what would be the label, this is to set out the framework which would ease this, because it wouldn't be a top-down approach, but rather a bottom-up, taking into account, as Tillman said, the fact that each country has its own product specifics, knowledge of the market, needs. Maybe auto-enrollment isn't such a need in the Netherlands, but it can be it can be a need elsewhere. So considering the investment in European companies, in the European fabric, economical fabric, considering if we see the investments, the consumer protection and the risk mitigation you do have to offer in these products, because it's not because you invest in risky assets, such as non-listed assets, that you can provide in the product certain guarantee framework to mitigate this risk. And in this respect, we believe that using the funds we know with LTIFs, with UCITS, can first of all provide this framework to the saver, and setting up in the different products what would be a default options for investments, and being on a guided, balanced allocation where you have risk mitigation. You invest a lot, or you invest more in risky assets when you have 30 years in front of you than when you have 5 years or less. So this has to be designed not with a solution which would be the silver bullet, one fits all. That's not if this was evident, I think we all should have figured it for a long time. So today this has to be think and developed, but with respect to these main core principles, which would be ease the investment and easy investment in the European economic fabric.
Can you overcome the hurdles on liquidity within the context of the French savings and system and cost?
Yeah, so that's a great that's probably the most important question, the liquidity, and that's related to long-term investment. You can't finance equity. You can't massively invest in stocks if it's only for 1 year or 2 years, or if you have huge amount of redemptions on this. And that's why the long-term designing these investments in long-term products is a good thing. The unique long-term product is our retirement products. But should long-term investments be necessarily related to pensions or to retirement products? Maybe not. Maybe the time you remain invested in these different assets, and you have to, if you take risk on non-listed assets, and if you had liquidity needs at the moment, you do have to provide a product in which the redemption of your savings is limited.
Yeah,
authorized but limited. Yeah. And so that's all about the framework of the product. We do have many provisions in the European law about how you manage equity in the different funds and the different mechanisms you can have, such as a gates or things like this. But the most important is that if your savings are invested at the long term, and that some people have to have to take their capital, if you have huge amounts which are invested, this is not a problem regarding. Yeah.
So liquidity can be managed within the structure. So we have to move it on. So a final word on this question to Marius: do you have private markets in the portfolio? What capacity would there be to increase that allocation? Just have to ask you to be brief because we do need to round off soon.
Yes, we have such instruments in our portfolio, but at a very low level, and it's about also the regulatory barriers that force us to have a low level of this. Probably will be increasing. But on the other hand, we are talking about a young system and about the trust behind the system. So if in Romania now we are talking about 65% allocation in risk, 50? Oh, 50, okay. It's something out of discussion to looking at such big risks, but otherwise we have to think about take more risk in our portfolio, and related to the fact that the instruments that are available in the Romanian market will not be enough. Hopefully, as Radu said, that in following 4 or 5 years you will double the assets, and of course you have to go in other instruments, and is desirable to have instruments with high return behind this. But at the same time, we are talking about the guarantees, and the balance between this one has to be very clear. And so far, a young system, it's very vulnerable in case of something. If something is going wrong, we actually have 2 pillars that is running, but everything wrong can happen in pillar 3 will affect the pillar 2 and vice versa. And from this perspective, taking more risk and looking for the different instrument class heavy ban opportunity, but again, looking at regulatory framework and at the approach that we have to have there. We do believe that anyway, we have to, the world is changing a little bit. So we are talking about the green ESG and other things. Now we have to looking also to other instruments. I will not talk about the private investment and other type of instruments, but there are some other classes that probably will be interesting, and we are willing to be part of these instruments to if I'm talking about the defense with some extent, for example, not in weapons, but in different defense has different shapes. So for sure we can and we want to be part of this kind of investment.
Thank you, Marius. So I just had Jack, do you want to come in on the private markets question? I have to ask you to be brief.
More on Gregory, but quickly. It is not so that our risk budgets are limitless. It is a widely diversified portfolio and considerations with regard around risk and return. And that is also what we previously discussed with Tillman. If we were to discuss taking more risk in Europe, the most important thing to be said, I think, is give us investable products that we understand, that have the right contractual basis, and where we can do our risk return exercise. And sometimes it can be that we just have to say the risk is too big.
Right.
So, and then we need a first loss or structure it by any means. So talk with us in terms that we understand.
Yeah, and there can be tax incentives that might be interesting that could be structured. And presumably you're thinking securitizations, that's a good thing. That's going to be pushing quite a lot of risk off the off banks' balance sheets, and participants in this room will be taking up some of that risk in private credit, no doubt. Gregory, one very, very brief word. Did you want to come in?
Just a word about the funds which can be used in this respect with LTIFs today, and you can mix, you can combine non-listed assets and listed assets and different kinds in the same fund and in a long-term perspective. So we believe that the new iteration of the LTIF will help. And we have much expectations about this in France with the Green Industry Act, and so now the place of these non-listed assets.
Right. So some of the ingredients are in place to facilitate this shift towards productive assets, if we want to call them that. So final point for all of the panelists before we go to coffee, I'll have to ask you to be more bullet point in your answers. Is the you've heard a lot from Tillman Luda. We've had quite a lot of discussion. This is a great opportunity to feed your key message to the European Commission. I'm hoping that Tillman is still with us. We can't see him. I can't quite see him on the screen.
Yeah,
I
am here.
Very good.
Yes,
okay, so I'm just going to start with Jacques, and let's just run through the panel.
Keep up the good work, grow the European capital market, do not get tired, and see to it that Europe accrues more pensions.
Short and sweet. Thank you, Jacques.
Yes, so European directive can help us to grow and to stabilize the pension business in Romania. So we are wondering to see if we can find something that looking at what allies our countries, not what differentiates our countries, because the products and the countries and the markets are totally different. But I do believe that can be found solutions that are common and applicable for all European countries.
Excellent, thank you, Beata.
The diverse landscape we do have and which we represent as well. I think we see this every time we talk about European pension systems. So there's no one-size-fits-all approach. Talk to the member states, look at them, take best practices, and do not give one product or one legislative to all of them, because this would endanger in some countries and some member states the existing systems. Be aware of this. This would be my pledge.
And Gregory.
Maybe, pardon. In a few bullet points. First of all, the European investments, which is the most important objective with SIU, and maybe to agree with you, a good balance which has to be found between flexibility, freedom of choice for the savers and for the different managers, and managed or guided solution to provide a framework for those who have to be need a kind of a framework or advice to invest.
Tillman, you're still with us, so do you?
Yes, absolutely. Yes, can you? Are we back on? Yes, so thanks a lot for all this advice. First of all, I want to thank Gregory, because he mentioned the LTIF at least 5 times, and the LTIF is one of my babies in a previous job. And I'm happy to see that the LTIF is finally taking off. Initially, when we did the LTIF in 2012, 2013, everybody says that we were onto a loser. And I think with the latest reform, it's really taken off, and we expect the billions. And the LTIF is also a vehicle where you can get diversified access to the private markets. And if the LTIF has a strong European pocket in there, not necessarily by legislation, but just because of the way that it works, this is probably for the smaller funds a wonderful opportunity to get indirect access to these markets. I also want to thank everybody for noting the 3 essential things that we have to consider when we look at private markets, which is duration, liquidity. But the third one nobody mentioned, and this is where I'm a bit worried, which is scale. So, I mean, Jacques said very clearly, you need to have the duration, so you need to be a long-term investor. Your liabilities cannot come through immediately. So that's fine. And Gregory, we had a long discussion about liquidity and how to manage liquidity. And that's also fine, that you have to have some liquid pockets. But nobody mentioned scale. And I think that is very telling, because the one thing which distinguishes the Netherlands from the rest of Europe is scale. And the one thing which distinguishes Europe from places like Australia and Canada is scale. So you have places like Canada and Australia, which are relatively small economies, which have a huge funded pension sector. And then you have countries like the US, which is a relatively big economy, which also has a sort of very big pension sector. And then you have the European Union, with the exception of the Netherlands, which has a relatively big economy and a very small funded pension sector. And that is, I think, where the big challenge is. And I don't think we can get around with all the liquidity management tools and all the LTIFs funds on the planet without addressing the lack of scale. And I think there is a positive correlation between investment returns, portfolio diversification, and scale. And that is one thing where we will have to keep thinking a bit beyond what we did today. And that's basically a bit of the homework that we'll have to manage in the future. So thanks a lot.
Thank you, Tillman. I think that will have to be food for another discussion. Hopefully you will be able to join this group, this organization in another event in person. But we'd like to thank you for your participation throughout this panel. I'd like to thank the panelists. Please join me in doing so. So we have eaten into the coffee break a little bit, and I think we're coming back at 25 minutes to 4, if I've got that correct. Thank you.
Interesting session, so have no fear. This third session involves a keynote speech and a panel discussion focusing on the potential of infrastructure as an asset class. I won't speak further. I just have the pleasure of introducing Christian Roy, Head of Central and Eastern Europe at Amber Infrastructure Limited, which is a global fund manager with over 16 billion assets under management. Christian is from Quebec, but based in Prague, and hand over to you.
Thank you.
So good afternoon, everyone. It's my great pleasure to be here today to talk to you about the infrastructure as an asset class, a topic for which I'm quite passionate. So I will talk about what it is, why it makes sense for a pension fund to have an allocation to the asset class, especially in the current context of high volatility. And as I'm responsible for Central and Eastern Europe, or CEE, I will also touch upon why we believe it's an attractive destination for investment, but also what are the obstacles for local pension funds to invest in the asset class. But before I do that, let me just say a few words about my organization, Amber Infrastructure. Amber is a specialist fund manager solely focused on infrastructure, and this for the last 15 years. With over 175 investments to date, that makes us one of the most active managers in that space. In recent years, Amber has started to differentiate itself from its competitor by establishing a local footprint in the countries in which we invest. And this is how we built what we believe is the largest team in the CEE region, Central and Eastern Europe, where we are responsible for the 3 Seas Initiative Investment Fund, which is broadly like a €1 billion fund dedicated to investing in the CEE, which was funded by local development banks, but also a few private investors. So let's talk first about why infrastructure is especially relevant in the current political and macroeconomic context. So on the political side, as you know, the government policies across Europe, but also at the EU level, are now prioritizing the development, but also the strengthening of critical infrastructure. These projects, which aim to increase overall resilience, security, and connectivity of infrastructure, will require capital-intensive investment. In parallel, as you know, net zero targets also remain an important topic, requiring continued investments. However, budget constraints will not allow governments to fund all needed projects on their balance sheet. This suggests that the funding of infrastructure will increasingly shift towards the private capital. In parallel, macroeconomic uncertainty linked, for example, to the Trump administration and the ongoing war in nearby Ukraine is making the infrastructure asset class more attractive due to its low volatility and low correlation to other asset classes. Given Trump's tariffs may create inflationary pressure, this will also make inflation-linked infrastructure investments more attractive. So when combined, we believe these tailwinds represent an opportunity to invest in real assets underpinned by strong structural trends. So what is infrastructure? So infrastructure is broadly defined as the networks, the systems that provide essential services, facilitate economic activity, and enable the movement or storage of goods, water, energy, data, and people. They are broadly defined by 3 characteristics. Their essential nature, so they provide basic services to ensure the everyday functioning of society, whilst also supporting economic growth and quality of life. They are also less volatile, as demand for infrastructure is relatively stable throughout the cycle, even during economic downturns. They are also stable and predictable, associated to stable and predictable cash flows due to regulation, long-term contracted revenues, high barriers to entry, or monopolistic position. When we talk about infrastructure, it's useful to distinguish between public and economic infrastructure. Public infrastructure refers to services typically funded or backed by governments, facilities like schools, social housing. These assets are driven by public need and often have long-term contracts with government entities, making them strongly predictable and stable. Economic infrastructure, by contrast, include assets like airports or fiber networks. These serve commercial activity and rely on user demand, whether it's traffic volumes or on a toll road or electricity consumption or data usage. They tend to be a little bit more exposed to market forces and economic cycles. There are really four infrastructure investment strategies available to investors. Each one appeals to a certain types of investors based on their risk appetite. Supercore, on the left side, is the most stable, think long-term, government-backed, regulated assets. Core adds a bit of risk, such as toll roads or solar farms with power purchase agreements. Core Plus involves more market exposure or operational complexity, like telecommunication towers. And finally, value add is where the upside is driven by value creation initiatives or active asset management, like rolling out fiber networks or developing EV charging infrastructure. When it comes to the popularity of pension fund, the popularity of the infrastructure asset class, the appetite for infrastructure investment remains quite robust, with 35% of investors saying that they are planning to increase allocation to infrastructure in the near future, and another 59% choosing to maintain current allocations. Historically, public pension funds have been the leaders when it comes to infrastructure allocations, and that trend continued into 2024. However, the most notable shift last year was seen with private pension funds, growing their allocation from 5.5% to 6% of their assets under management. It's also worth noting that larger pension funds often set higher allocation targets, reflecting their additional in-house capabilities. For example, in Canada, where I'm from, many pension funds have targets of 10, 15%, even higher. Here in Europe, and it was mentioned in the previous panel, like when one person commented about scale, some larger pension funds, such as APG, has recently announced that they were increasing their target allocation to 10%. There are three methods that limited partners, LPs, can use to access infrastructure investments. Indirect investment means committing capital to a fund managed by a general partner or manager. It offers broad diversification, professional management, and lower resource requirements. But obviously, it comes with management fees and less control. Co-investment allows limited partners to invest alongside the fund in specific deals. It provides more control, often with lower fees, and the ability to target preferred sectors or geographies, but it requires faster decision-making and more internal capabilities. On the other end of the spectrum, direct investment is when the limited partners originate and manage deals themselves. This gives obviously the highest level of control and potentially lower cost, but it demands significant in-house expertise and resources. It's not unusual for pension funds to start with indirect method, then build expertise over time with co-investments. And if the pension fund has enough scale and can do it, develop an in-house direct investment team. However, we would not advise to start with the direct investment method, given the complexity of the sector, as we saw many inexperienced investors get burnt that way. So why invest in infrastructure? Infrastructure has historically remained stable during periods of market volatility, as is currently the case. This was also illustrated by its relative resilience during two recent downturns. So during the 2008-2009 global financial crisis, infrastructure fell by less than half of the drop observed in global equities. And during the more recent COVID pandemic, even though it had unprecedented impacts on transportation volumes, many other infrastructure sectors, such as utilities or digital infrastructure, have proved quite resilient, to the downturn. From a total return perspective, the asset class performed quite well, falling just 4% compared with a loss of 20% for global equities. The general expectation in the industry is that infrastructure would fare relatively well if the trade war initiated by the Trump administration persists. Infrastructure assets, particularly private, unlisted infrastructure, tend to be less correlated with other major asset classes and listed markets. This is largely due to their regulated, contracted nature with their monopolistic position to deliver essential services. On a risk-adjusted basis, unlisted infrastructure has typically outperformed other asset classes, as reflected in a higher Sharpe ratio. As you can see on this chart, infrastructure returns have shown resiliency also regardless of the inflationary environment. The reason infrastructure can play a helpful role in protecting investments from inflation is really twofold. Many infrastructure assets have revenues linked to inflation, either through regulation or long-term contracts. For instance, tolls may increase annually with inflation, or energy tariffs may be indexed over time. Even when not explicitly linked, these assets provide essential services that people continue to use regardless of economic conditions, which means the providers often have some pricing power to keep up with rising costs. This makes infrastructure especially useful in preserving the real value of investment. Another key attraction of infrastructure as an asset class is its long-term nature, which makes it a natural fit, I believe, for pension funds. Most infrastructure assets have very long lifespans for operating for 20, 30, even 50 years or more. This long-term horizon aligns well with the goals of pension funds, which need to match future liabilities. Another interesting aspect is that infrastructure can also provide regular income, which is achieved by the ability of infrastructure investments to provide a stable cash yield over time as a result of its predictable cash flow. Infrastructure projects also help stimulate economic growth by enhancing productivity, creating jobs, attracting new investment, and improving the economic output. For pension funds, this means investing in local infrastructure provides an opportunity to invest in key economic drivers. In turn, this economic uplift creates a virtuous cycle as infrastructure boosts economic performance and indirectly benefits pension fund by increasing the size of the investment pool, creating greater funding capacity for future liabilities. As we are based today in Romania, I would like to say a few words more specifically about Central and Eastern Europe, the CEE region. I will focus more specifically on the 12 EU member states that make up the CEE region. Despite the geopolitical challenges arising from the war in Ukraine and the current macroeconomic uncertainties around the potential trade war, the CEE region, we believe, remains an attractive investment destination as it combines on one side the stability of EU membership with all of its institutional frameworks and legal frameworks and governance, alongside with high growth that we would typically associate with more emerging markets. Also, we see that there are two important gaps in the infrastructure landscape of the region. So first, there is a gap in quantity and quality of infrastructure. The region still lags behind Western Europe in terms of infrastructure development. For anyone who has traveled here via Bucharest Airport, this is a very tangible reality. Second, there is a financing gap with a notable lack of private investors currently participating in the market. So the disparity on one side between the need for infrastructure investment and the available funds on the other side, particularly from institutional capital, really creates an environment where attractive risk-adjusted returns are achievable. Also, whilst not all countries are OECD members, we believe this creates a significant valuation potential, upside potential, given it is expected that there will be an influx of new investors once OECD membership is granted, as such providing a distinct first mover advantage for early investors. The CEE region also remains one of the fastest growing regions in the European Union, effectively becoming its growth engine. Over the past decade, the CEE has historically offered around a 2 times growth premium compared to the rest of Europe, and this trend is widely expected to continue. This growth can be attributed to several factors, including the convergence with Western Europe. Taking one country, for example, Poland, increasing its GDP per capita, and it's expected that next year Poland will surpass Japan on this measure, which is quite incredible. Also, the EU and other sources are injecting significant funds into boosting regional connectivity, which in turn is driving productivity. Also, following the disruption of supply chains during the pandemic, as well as the trade tension arising from the Trump administration, the region is poised to become a key site for nearshoring activities, with more goods likely to be produced locally. And finally, the green transition, which is driving substantial investments in line with broader European sustainability objectives. However, despite the region's attractiveness, there are several obstacles preventing local pension funds from fully engaging in infrastructure investments. And we'll be discussing some of these during the panel, but just to give you a little overview, these include regulatory restrictions. There are limits on private infrastructure investment. An example here in Romania, where pension funds are effectively restricted to under 1% of their assets under management, and that includes not only infrastructure, but also all other alternative category. There are also liquidity requirements, as the illiquid nature of private infrastructure investments really can be a challenge for funds with shorter term needs. And as I mentioned, there's this perceived risk around the infrastructure asset class, where often regulators will put infrastructure in the same category as other alternatives, such as venture capital or private equity, despite, in my opinion, very, very different risk profiles. This situation really represents a missed opportunity for local pension funds. Not only are these funds unable to take advantage of the potential benefits infrastructure investments can bring to their portfolio, but they're also missing the chance to support much needed infrastructure in their own countries. Taking Romania, where we are, as an example, my understanding is that the pension industry here in this country is worth over 30 billion euros. So assuming an average allocation of 5% in line with global trends, this would amount to 1.5 billion euro of equity available for investments. Given that infrastructure normally can be quite leveraged as a result of its predictable nature, and assuming relatively conservative 4-to-1 or 80% leverage, this would mean that allowing pension funds to invest in infrastructure could unlock 7.5 billion euro of investment for infrastructure projects. This could potentially be quite a game changer for a country like Romania. Instead, much of the local infrastructure is funded by government sources alone, or even by foreign investors who are capitalizing on the opportunities in the region and often take control of critical assets. This situation could be quite different if domestic pension funds were able to participate more fully in the infrastructure market. I want to thank you for your attention, and if you want to come and have a chat with me after this, I'll be very happy, and I have my colleagues Erika and Edward at the back also with me here today. Thank you very much.
Thank you, Christian. I think you can probably take a seat. Christian will be joining the panel discussion that Matti, or Pensions Europe's very own Matti Leppäla, will be moderating. I think we all know Matti, Secretary General of Pensions Europe. I'll hand over to you.
Thank you, Sue. This is such a popular topic that we have 5 speakers in the panel, and I can see that we have 5 chairs, so I will stand up. So please join all of you, and thank you, Christian, for an excellent keynote. You really explained what infrastructure is and how important and beneficial it is, and also some of the challenges that is faced within, especially in the Central Eastern European region, and like countries with limitations in regulation, like in Romania. And I'm very happy to have an excellent panel here, starting with Stefan Zalov from the European Investment Fund. European Investment Fund is, I guess, you are the most important infrastructure investor or institution that is promoting and pushing forward the infrastructure investments in various different structures. So what is your take on what works and what should be done in infrastructure investments across Europe, but especially in the CEE region from the point of view of the European Investment Fund?
Thank you. Good afternoon. Maybe I'll take a step back, because the European Investment Fund is probably better known not for infrastructure, but supporting venture capital and private equity in Europe. I think when we speak about infrastructure, it's a relatively young asset class for us. We've been investing in it for the last 5 years. Before that, it used to sit with our mother, the European Investment Bank. At the same time, we have accumulated experience of over 20 years of investing in infrastructure across Europe. More than 8 billion has been invested in more than 150 different funds, again, across Europe. Just EF alone has invested 3.5 billion over the last 5 years. Maybe to differentiate our role from probably what the pension funds in Europe are investing in infrastructure, we are a return-driven investor, but also a policy-driven investor. So I think Christian had a very nice chart on the kind of risk-return spectrum of infrastructure, and we tend to position ourselves in the core plus and value-add segment, mainly because our policy mission is to drive new capex with our investments. So about 60% of our portfolio is focused on capital investments into new assets or refurbishing, enhancing, upgrading existing assets, and 40% is focused on operating assets that they're driving yield. As you mentioned, we are investing across the sectors, from energy and all the subsegments to transport, digital infrastructure, including also social infrastructure, which is probably a bit of a peculiar beast for the other segments. I think in general, we have to be bullish by the policy narrative, but we are also bullish by the economic narrative. I think also Christian mentioned it, the ask to invest in infrastructure globally, not just in Europe, largely surpasses what the public budgets and the deficits can support in the long run. So it's a growth story. I think we all know that any euro invested in infrastructure drives a multiple of euro GDP growth. So it's just a question to what extent basically the investors and the pensioners will be allowed to be part of this growth story in the long run. I think happy to elaborate a bit further on what our returns have been, because I think probably one of the issues of the pension funds, particularly in this part of Europe, but not only, is the data. What is the long-term data of infrastructure? I think also Christian has a nice slide of, if you add just 10% of infrastructure to your portfolio mix, you increase the return, you reduce the volatility. I think it's probably 0.5% of an increase per annum, but if you add this on a 30-year horizon, it's massive. So this can be kind of the delta that really plugs in liquidity gaps and outs the premium in the pension funds allocations. But happy to chat further.
Very good. Thank you, Stefan. Good start. Then I'm moving to your left to Robert Zatkovsky, who's from ABG Asset Management, and ABG is, of course, the biggest of the big Dutch pension funds service provider for APAPR, and has long experience, plenty of experience with infrastructure investments, And I mean, if you look at the European infrastructure landscape, of course, we have many big investors from outside Europe. We have the North American pension funds, we have Australian investors, but ABG is one of the big European investors. So what's your take on the opportunities and challenges? And I know that you have done investments in infrastructure in Poland, but what about the rest of the CEE region from a big investor point of view, like ABG?
Yeah, so thank you for the invitation here, and maybe taking it, Stefan, a step back. So our journey as APG with the infrastructure segment started in 2004 with a relatively small allocation. And similarly to all the other pension funds, approaching it through the fund structure, so from mutual funds or commingled funds, and over the years, by gaining through more experience, obviously we developed our portfolio here quite significantly. So we went through different asset management, managed account structures with funds, specialized funds, and now we are focusing more in a direct investment route, which is the majority of our portfolio. On our portfolio, I think a lot of things have been said here. So we have roughly 600 billion euros under management, and currently an exposure into the infrastructure segment reaching 30 billion euros. And we have an ambition to increase that exposure, as Christian said, over the upcoming years to 10% of AUM, reaching roughly 55 to 60 billion euros, which, as you see, are quite significant numbers. So obviously the CEE region, we see the attractiveness of this region in itself. So it's characterized by a lot of growth and with a huge success story over the 20 years. So I can compare it also to the APG infrastructure success story. We started 2004. Most of the CEE countries joined the European Union in 2004, and over the 20 years on both ends, I think tremendous growth and tremendous success. However, CEE is a very fragmented market in itself. So on APG end, when we approach the direct investment, so we are always looking for a direct entry ticket at day one of reaching 250 to 300 million euros. Reflecting a particular stake in a company or in an asset. This is obviously very, very difficult in the CEE region. So until now, we manage only two step or entry investments into that region. One is a joint venture with Orange Poland, focusing on building out the fiber network outside of the large cities. The other one, we are co-owner of a motorway in north of Poland, or actually a majority shareholder there. Those were the two large tickets which we were in a position to do. Historically, we haven't seen a lot of other options which were allowing us to do those tickets. Yeah, so it's I think that several elements probably which makes it difficult. So as I said, CEE is quite fragmented in itself. Some of the countries are per nature very small and not giving just the capacity of such a tremendous capital allocation. We have still a lot of, let's call it past constellations in the CEE region where we see companies active in the infrastructure are still in a public hand predominantly or in a semi-public hand, which makes for us the segment difficult to enter in as a private investor. And obviously the third point is, which is always somehow coming back. However, maybe now from today's perspective, we should always look on that with a pinch of salt. So the regulatory stability in the CEE has been probably more volatile in CEE as in other Western European countries or in North America. Nowadays, it's maybe a little bit relative in itself, but there is an element of that as well.
Thank you, Robert. You're a big investor. Turning to Tadas Gudaitis from Lithuanian pension funds. Lithuania is, of course, one of the small countries with a relatively young pension system, in my view, great success in building assets quite rapidly, but also quite diversified outside Lithuania. So I guess limited opportunities to invest in Lithuania overall, but also in infrastructure. So how do you see the role of the Lithuanian pension funds in infrastructure investments as a whole, outside Lithuania, but also in relation to Lithuania and Lithuanian economy and building in Lithuanian infrastructure? What could be the role, what should be the role of the Lithuanian pension funds in this picture?
Yeah, so good afternoon and thank you for inviting. So, you know, by being not the first speaker, probably it's a little bit more ready to repeat or to connect the dots which were already set. So looking from, let's say, Lithuanian perspective, from local pension funds perspective, I would like maybe to raise a little bit discussion to this point, which is, you know, some kind of question of this chicken egg type of, you know, the situation. So do we have enough project to invest to? And I think we're already hearing that there are some kind of, I would say, a little bit of the limitation of the potential infra projects, which would be well defined, well run in the region, and looking especially in the Lithuania. At the same time, you know, if the question is about, are there enough money to invest or capacities to invest? So as you, Mate mentioned, so I would say that the, you know, pension systems or pension funds are growing. So there are more possibilities to invest because there are more assets under management to invest. But of course, there should be also some kind of, you know, investment value into it as our fiducial duty to generate the returns to our participants. So I would say from money perspective, I would say that there are assets are growing and they're in place. At the same time, if I would talk maybe about Lithuanian, Baltic pension funds, but I would make an assumption there would be similar situation in other Eastern European countries. It's also about our internal capabilities to invest. So again, let's imagine, you know, there would now suddenly appear 100 projects on the table, like, you know, like the funds, you know, or the projects itself. I think also we have some kind of a little bit of limited capability in the organizations, you know, to do proper due diligence. It's a long way process, you know, it requires resources and things like this. So what I see that currently for portfolio managers is much easier to, you know, to press the button and buy some kind of ETFs type of the product rather than, you know, to get into very much, you know, detailed due diligence of such investments which are required, I think, by its essence. But looking forward, I think the prospects are good in taking into account, you know, what, you know, Representative Tillman from European Commission said that, you know, there would be some kind of like regulation or the base for bigger investments in Europe. So I think, you know, pension funds would adapt and would look at these opportunities more in the future. So probably would be like this.
Thank you, Tadas. Indeed, investment opportunities are key. Then turning to Alina, naturally, you're with Allianz Pension Fund here in Bucharest, but you have also been, I guess, the whole duration of the Romanian pension funds participating in this, and you've seen the developments of the investments and the opportunities or the lack of the opportunities. But what would you say from Romanian perspective about the infrastructure investments and how could they be done in a good way for Romanian pension funds? We heard from Christian that there was a 1% limitation for all alternatives, which doesn't, of course, allow investments at the moment. So what should be done?
Good afternoon. And coming back to what it was mentioned, that it was 1%. In fact, it is 1% for private equity funds and 15% for infrastructure funds. But if we see them, however, layered, because infrastructure funds behave like private equity funds, might be interpreted from some points of view, lawyers' points of view, that it should be safer to keep it somehow in line, those two limits. Going back to the Romanian pension system, as it had been pointed out today, 95% of our assets are invested in local instruments. And when we look at this percentage, of course, we become credible when considering that pension funds in Romania would be here to support infrastructure projects as a priority for this country. Because it would be difficult for us to consider that we will not be supporters of any significant project that could develop the country. And the one other aspect that it was also mentioned in the morning, I think it was the fact that every 5 years our assets are doubling. So whatever was pointed out by Christian earlier, that if we consider currently a 5% exposure to infrastructure, considering our current assets, in 5 years from now, these numbers would double. What has happened is we were allowed back in 2020 to invest in infrastructure, but as you all know, 2020 and 2022 were years in which we're focused on different subjects. And nowadays, I think there are some elements that have to align in order for local pension funds to go towards infrastructure investments in a more faster way. What we see is, firstly, we need to have some kind of policy stability, and this go to different layers. In the first place, we need political stability, because as we know, investment in infrastructure could span over several decades, and we have to go to different electoral cycles. And at that point, we should have confidence that the politicians are very much committed to supporting and keeping the framework stable for the investors, being also pension funds. One other aspect to be addressed is the fact that also policymakers in Romania should set priorities on infrastructures. And when setting this priority, I think pension funds would have a clear roadmap in choosing their investment opportunities. And also under these policy stabilities goes also the fact that there could be a dialogue between government and pension funds in order to identify the priority sectors in which investments in infrastructure are needed for Romania. And going from that priority sectors, I think there could be a more focused orientation of the investments from institutional investors at the end of the day, not only pension funds. And aside from this policy stability, we also see something else to be addressed, like enhancement of communication. So a constructive communication, firstly between the regulator, the policymakers and pension funds, mostly like an ongoing dialogue through forums or gatherings in which we should address aspects that are concerning us as an investors, and also regulatory matters that should be clarified, addressed, made more transparent at the end of the day. And also one other aspect, where aside from political stability, aside from this permanent dialogue that has to be put in place, is the fact that legislation should not be changed so frequently. So for us as an investor to have clarity of how the rules and the requirements are set through the entire period of an infrastructure investment, which as we know, it would take more than 10 to 15 years, at least for one such investment. I think these are some priorities that can be addressed. And when these are, let's say, addressed, we will be more prepared to look at this type of investments.
Mm-hmm. Indeed. I think many of you have said how important the stability and political stability are in long-term investments like infrastructure. Christian, Amber Infrastructure, I think you've done more than 200 infrastructure investments in different jurisdictions. What is your experience with the political stability and how to deal with this? Because pension funds in the past in Europe have been burned in some of their investments when they've made long-term infrastructure investments, and then the governments have changed the rules, and there's very little you can do about this. I mean, I've discussed this long time ago in relation to emerging markets, and big investors said, with emerging markets, you can debate. With the German government, you cannot. So what's your experience in dealing with this risk in your investments?
No, it's a very good question. Indeed, engagement with political sector is very important, because ultimately infrastructure assets, in most cases, are assets which have like a component related to the governments, and having some stability will then make the investment more palatable for investors such as us. Just giving some example, when we invest in renewable energy, if there are changes to feed-in tariffs, clearly like this a bit undermine the investment thesis that we made initially. So these kind of changes of regulation are not helpful. So, I mean, there's no like silver bullet. It's about engaging with governments, explaining to them that making changes is undermining investor confidence, and ultimately, increasing the cost of future projects, because investors looking at making investments in the CEE region often will require a bit of a higher return on their investment, because not only in the CEE region, it's true for other markets as well, because they believe, and maybe now it's going to happen in the US as well, because they believe that like they need to be compensated for the additional risk they are taking. But in infrastructure, there are also, as I mentioned in my presentation, there are also like some subsectors that are less related to government. So really, like when I was talking about public infrastructure, this is really related to governments. But when you move a bit up the risk spectrum, there are some risks, some subsectors that are less exposed. So it's about also finding the right balance. Just to give you an example, we have invested in a company called Cargo Unit, which is a locomotive leasing business. So what it does is it acquires modern, environmental friendly locomotives and then lease them to private and public rail cargo operators. So it's operating here in Romania, but across the entire region. So this, for example, is less exposed to governments because really it's private by nature. But what we are doing is like giving the opportunity to such companies to grow up, scale up, and be able to achieve their ambition. So it's also like not only investing in assets that are exposed to government changes, but also like finding this balance with these other sectors.
Thank you. Yes, Stefan.
Just to add maybe a point on, indeed, there's no silver bullet, but I think one thing that could help mitigate any kind of intervention that goes against the value of the underlying portfolio is diversification. For example, ourselves, we have been heavily exposed to solar wind assets when the feed-in tariffs were slashed close to 10 years ago. And on a portfolio level, again, we're a fund investor. Our returns have remained within the target, even though some of the underlying exposures have been pretty much returning at cost or even below cost, which for infrastructure is not very typical. I think another element with the long duration of infrastructure as a holding period, you also have means to optimize the asset further at an asset level when certain elements are not going in line with your plan. So I think actually holding it for longer allows you to pivot and take let's say extra revenue streams that can support the target return.
And maybe just to add to what Stefan is saying, also, like having an entity like EIF as one of your shareholders in a fund is also quite helpful, given the dimension, the public dimension. And in the case of the Three Seas Initiative Investment Fund, which is our CE fund, we have like the local development banks as investors. So that also help mitigate this risk.
Yeah, indeed, the public element, I'm sure, is important. But Stefan, you said you're a fund investor, but what would you think would be the best structures to channel investments in the infrastructure in Central Eastern European region from your perspective?
The structures, I think difficult to say because quite honestly, the asset class here, it's quite underrated. When we speak about infrastructure from institutional perspective in CEE, it's almost inexistent. I think again, we have the lens of a fund investor, so we see players like Amber and a few others. I think probably, and others would attest to that, the Baltics are a bit more developed from my perspective compared to the rest of the CEE region, by far not as close to Western Europe. So I think probably the ingredients are the long-term capital allocators have to be allowed to take more exposure to infrastructure. I think on the risk return spectrum compared to private equity, compared to venture capital, it's different. It diversifies the portfolio. I think there's data to support this, if not so much in Europe, for sure in the US. I think there's data to support this that can be useful. I think it takes also a bit of local sophistication of the players that are investing in the infrastructure, not so much the kind of the public infrastructure as Christian was mentioning, which probably they're assets, but they're not an abundant amount of assets which would be within the range of big allocators to participate. But when you go, for example, to the lower and mid market where the tickets are between 50 and 150 million, there's many assets. But then it takes a different skill set to pursue this asset. It takes local understanding of the regulatory, political nuances, culture, or what have you. And simply there aren't that many players that are operating locally. So I think many of these ingredients have to come into play. Probably there's a kind of a generation to go through to allow for the market to mature. But I think from our perspective and probably from European perspective, I think that the tailwinds are there. The carbonization, even though today it's all about defense, it's not going. Europe is a energy poor continent. That would not change in the maybe at all. So we need to invest in the carbonization. We need to invest in generation. We need to invest in storage. Digital is probably the other sector that we have started speaking on, but there hasn't been as much investment going. But when we speak about data centers, for example, there's going to be a massive push, and public sector will not be able to support that. It needs to come from private means. So this probably that will be all the kind of elements to come into play to allow for more, let's say, maturity of the asset class. Probably just like it was with private equity 5-10 years ago, it was pretty much non-existent. Slowly, track record came in, expertise came in, and I think the wheel started spinning. But just to maybe relate to the previous panel where I think the Netherlands was put as the special system in Europe, from our perspective, when we sit as a limited partner alongside other investors in funds, it's ourselves, our colleagues from Netherlands, Canadians, US, Asia, and maybe then some of the Nordic countries. This is recurringly across funds, which are European funds. So that's a big question. Where are the big allocators that should be local, understanding the asset class, and entering into these investments? Again, this is from the eyes of a fund of an investor. Maybe on a direct basis, it's a different approach.
Thank you.
I wouldn't say it's different. It's very similar. So obviously the market was lacking, or is still lacking the local capital. So you need to attract somehow the foreign capital coming from Western Europe, Canada, or the US, basically. And as you're correctly pointing out, yeah, the experience here is not dramatically there. There has been some movement, but it's not that there is a massive wave of opportunities which were brought to the market, and the capital for them didn't just appear. So there was always a kind of mismatch of the qualities of the opportunities. Maybe it was not presented in a way which it should have been, and a flavor of political or regulatory instability with some changes to taking, for example, the renewable energies. It's always a kind of good example because there are multiple examples for that over the decades already. So the ingredients for investing in Central Europe or Central and Eastern Europe are basically there. Maybe you could still make some systematical changes, like that's maybe not a limitation for APG, for example, like joining the OECD or joining the Eurozone. But there are a lot of funds which have limitations on those items, and before on both items we have tick the box exercise. Basically, a lot of Western capital will not go to those markets because they feel uncomfortable with even with currencies like Czech koruna or Polish zloty. Yeah, so that's just the reality as it is.
Taras, yes, I would like to your reflections from Lithuania, but also as Stefan was referring to the Baltic region as well. I know that you're familiar not only with Lithuania, but also what's happening in Latvia and Estonia.
Yeah, so just to say back, I think, like European investment to Stefan, I mean, European Investment Fund, the European Investment Bank, European Bank of Reconstruction and Development, I think they play really a big role, crucial role in developing, like even the private market itself, and including infrastructure. So we are together investors in some of the projects. I also agree and hearing that, for Western pension funds, probably the region is still a little bit too small with the projects or with the tickets which they can invest. But I think it will grow. And, one of the topic, I believe, which is already in the place or which is coming in, I would say in a weeks, months, and so it's about the defense infrastructure, strategic infrastructure. And, Christian, you also very shown, I would say, very well in your presentation when you see, CEE region and, the line between the, from north to south. It's about, our neighbors, which we have on the east side. So, I think the topic is actual everywhere. And for example, Lithuanian case just recently, our, defense ministry, they announced a bid of 2 billion euros, like a project to build from like greenfield investments of the defense infrastructure together with some kind of, roads and things like this. So if there is a project appears, which talks not about already millions, but let's say billions, I think it would be also interesting an opportunity, not only for local investors, but also for foreign ones. So I think the pipelines is appearing and defense is a topic. And I would say Latvia, Estonia, or Poland, or any other country in this line, I think these type of the projects are coming. So I always say it's some kind of an opportunity to local economies as well. So there are some kind of new jobs, new things needs to be developed, and it's good for economy. If there is an investment case, it's good for local, future retirees, because the money are invested from local pension funds. If foreign investors are coming, it's even better, you're attracting. So I would like to believe that, the future is more bright, to develop infrastructure projects. But as all mentioned, this political stability from different angles, including, stability of pension systems, as such, is also an important, because it's, as we talk, it's about investments of 15-20 years. So if for any reasons I would need to pay out lump sum before I planned to pay it out, probably I will not get the back from this investment full, and then I'm in trouble. So political stability is very much important as well.
Indeed, I think that's a clear message from all of you. Alina, with all the restrictions in Romania in place, how feasible or how possible do you see that the Romanian pension funds would be allowed to invest more in infrastructure? And do you think that they could invest also in defense or security infrastructure?
I think these restrictions are not restriction, but more are not very much clear somehow in some aspects related to how we make the valuation of such investment, how we are able to invest if we are not there at the first close of an infrastructure fund, and we go after that, and we have to pay an equalization fee, and local legislation requires us that this fee to be paid by the asset management company and not the fund that invests. So there are all kinds of aspects that can be clarified in case there is a will and the need for the pension funds money towards infrastructure. With regards to if we were to invest in defense, it's very difficult at this point, since we are not allowed to invest in weapons. It's clearly stated in the legislation. But I would not see defense as only weapon financing, but mostly as ensuring the security. And this could be security of the border, cybersecurity, all kinds of other investments that would also relate to security of a state and the region. And from that point of view, we have all seen that at least during the last 2 months, there are clear discussion at the European level, mostly for the Nordic countries, but not only. And I think we will see by the end of this year some measures that would allow some of the pension funds to consider investment toward this type of sectors. In Romania, I would not expect that the first investments in infrastructure to go towards defense type of structure, but mostly towards sector that would support the economic development and social development of the country. Because we still have to invest in transportation, we still have to invest in maybe energy, energy security, also healthcare could be a sector in which Romania might need some investments. We have some examples, but there are only a few of public-private partnerships, one of them being in healthcare sector and being with IFC in Romania. We need to see how this project would develop and what are the results in order to have also some kind of feeling how this would be also done by pension funds.
Thank you. I mean, many pension funds during the last 10, 15 years have excluded weapons or more broadly defense investments, but many are also now reviewing their investment policies, and especially in the Nordics, but also in the Netherlands. I know that Robert, your client or owner APP has new exclusion criteria, so excluding controversial weapons, nuclear weapons, things like that. But do you see then defense infrastructure as a good opportunity, or do you see that there's emerging investment opportunities in these investments going forward, as it is greatly needed by many countries? And I think the European defense policy is asking for also private investors to help to build the defense capabilities, and infrastructure investments play an important part of that question.
I think it's difficult, to go into details. It's probably very early nowadays to make statements. Obviously, there is a huge defense need, and defense is also a kind of blurry word. It does not mean only weapons, which are probably not on the agenda of investing for pension money, but there are also multiple options which are somehow connected to the defense of a particular country or for the wider scope of a European defense. And elements of that, well, from my personal perspective, might be also part of the future. Yeah. So if a student house is a PPP model, then why an army house cannot be a one? That's just my high-level thinking on this end. But as I said, it's a very dynamic field with a lot of dynamic discussions with apparently, as all the other sectors like decarbonization, circular economy, with tremendous capital needs over the decades. So there will be definitely developments over the years in this area.
Indeed. Yes, Christian.
Yeah, I just want to expand on this topic. So at Amber, we have made several investments in what we call dual use infrastructure, so civilian military. For example, we have invested in electricity grid on military bases, or we have invested in military housing, barracks. What we found is that until very recently, there was very little appetite here in Europe from investors to invest in these types of sectors. Really, there was a lot of, as Elina mentioned, there was a lot of restrictions around this. And for the CEE region, Central and Eastern Europe, it is very important, because most of these countries are what we call like border countries. They are bordering, countries that are not necessarily friendly towards the European Union. And huge investments will be needed. And it's not true that governments will be able to make all these investments. So we're really keeping a close eye on these discussions, and we're really hoping that there will be some important changes made to this. We don't expect that like weapons or armaments will ever become eligible investments. But when we talk about dual use, like infrastructure that can be used for civilian and military uses, we really hope there will be a shift because the needs are there, especially in this region. But at the moment, there's really very little capital available.
Yes, and I mean, a member of Pensions Europe Insurance and Pension Denmark has been for already a longer time been asking and advocating for investment opportunities for pension funds in defense, and now more broadly the financial sector of Denmark is asking for this, and that includes infrastructure investments. But what about then the European Investment Fund and your policies in defense investments, and also in relation to the European Investment Bank, which is part of the structure? Have you revised your views on investing in defense infrastructure?
It's a timely question. Yes, the views have been revised. They have stopped short of weapons of mass destruction. So anything that basically can practically cause damage, it's still outside of the scope. But dual use infrastructure has been allowed. This is not only for infrastructure, it's also in terms of venture capital investments in R&D, defense company. It's also in private equity investments in supply chain companies, part of the defense and cybersecurity sector. But I would side with the colleagues that it's probably early on to say how many opportunities there will be in the sector, because if it's kind of a social infrastructure, a la student housing via PPP, it could probably very much work well to be part of the portfolio infrastructure fund. But then it depends how the project is structured, and that is still, I think, path to be walked. But to be honest, probably 2 years ago, I was the one proactively asking infrastructure fund managers, have you considered defense, civil infrastructure, military housing in particular? And the answer was pretty much predominantly no. It's a kind of model for the Anglo-Saxon world. But I think now that kind of push has come to shove in Europe, to kind of say it simply, it's vice versa. I think mostly managers that are focused and are exposed to investments on the eastern flank are coming to us and asking us, would you be able and would it be eligible to invest such type of a project? Again, the closer you are to the front line, the more acute the need, the more you're closer to, let's say, Portugal and Spain. Obviously, that's not the first concern, but the defense infrastructure features. The question whether it's going to be a viable sub-asset class, time is to tell, but probably as part of social infrastructure or civil infrastructure, it has its space.
Yeah. And from the pension fund's point of view, all of this comes down to the basic fiduciary duty, which is to act in the sole best interest of the members and beneficiaries. But whatever that means is more complex. And the social aspect, for example, is important, because we have many good policy goals like housing, more urgent in some countries, less in some others. We have the energy questions, we have the green transition issues, we have the defense issues, we have many good policy goals. But what I think is really important for pension funds, that these are real investments with real returns and not political projects for other policy aims. And that is going to be a big challenge now also in relation to the defense investments. But I'm sure that if these are good investments, and I think that's what the European Commission is emphasizing, is that there will be many good investment opportunities for private investors like pension funds in defense, because the needs are so great. And if that is the case, these are good, sound investments, then I'm sure pension funds are happy to oblige. We are coming close to the end of this session, but then I would like to ask all of you, like if there was one policy recommendation in infrastructure investments that you would like to make, what would that be? Maybe starting with you, Tadas.
Yeah, so I think, Marty, you mentioned very well. So I would say maybe I would, if one thing, I would start from stability, but political stability, but maybe not only from infrastructure side, but stability also from the pension system or investor side. So I think this is an important factor to develop infrastructure or any other private markets. So stability also in investors side, in pension fund side.
Christian, and then I have seen Radu wants to have a question, but let's go through all of you, and then we'll have a few minutes for discussion still in the end.
Yeah, well, I will keep it short. I would encourage regulators to really align with international best practice to make sure that there are not obstacles preventing domestic pension funds from investing in their own infrastructure, and that's why we have partnered with PensionsEurope to release a white paper on this topic. So if anyone is interested, I would suggest you come on our website, and there's a forward by PensionsEurope about these issues, these regulatory issues, and how they are preventing really the growth in this sector.
Yes, indeed, it's a very good white paper on all of these issues that you mentioned, and thank you very much, Amber Infrastructure, for supporting our conference. Alina.
If we were to consider that the local pension funds would start somewhere investing in infrastructure, I would expect they will start with pilot projects regarding public-private partnerships. And on that side, the one idea would be to have standardized template contracts in order to make it clear, and the risk sharing, all the mechanisms put in place in such projects, or the guarantees provided by, let's say, the public sector in such projects, and also the dispute resolution process. I think starting from pilot projects and going through standardized setup would be a starting point for us as an industry and pension funds investing in infrastructure.
Thank you. Very practical as well. That is important. Yes.
Well, I can say from the asset perspective, it's always avoid any kind of retroactive changes to the setup which has been established, because that's always very damaging for the future. Yeah.
Thank you.
I would probably second Christian to allow the capital allocators to have flexibility to invest in infrastructure if so is their desire. I think from our perspective as an institution, we're happy to support with data. Again, we've been investing in the sector for the last 20 years. If you take, for example, just a slice from 2010 until now, the portfolio from bottom to top has performed between 7 and 10% cash on cash return. So the more obviously you segment it, the return is better. So again, the data is there. We're happy to share it. Also, we're happy to work with local regulators if we can support in any way kind of the toolkit to allow the pension funds to invest more. Also, we're working with the national development banks in the region to promote infrastructure as an asset class through various public-private partnerships. So we're open for basically for discussion to support more kind of long-term exposure into the asset class.
Thank you. Then we have a few minutes for questions and discussions, starting with Radu.
Thank you very much. Thank you. Christian, you use Romania as an example for an would-be infrastructure fund. So I'm going to pick the glove and ask you essentially two questions. One would be, how realistic is to have a country-dedicated infrastructure fund for a country such as Romania? This is the first question. How realistic is to have a country-dedicated fund for a country such as Romania? And if it's realistic, then the next question would be, from your point of view as a specialized and professional manager, how would such a fund should look like? Thinking about, I don't know, minimum size, investors, co-investors over there, and whatever else you think would be relevant. Thank you.
Yeah, it's a good question. To be very honest with you, I think Romania is probably too small as a country to have a fund dedicated to only investing in Romania. Normally, infrastructure as an asset class is more regional. So, like the example I was giving was more in relation to if the pension funds were able to invest, and then you would assume that on a pro rata basis, an amount would come back to Romania. But to go to your second question, I mean, in terms of structures, there are not that many structures out there. They are like listed and unlisted. Here in Romania, I think pension funds are more allowed to invest in listed, but the reality is that there are very, very little listed infrastructure funds. So unlisted, which is more like akin to private equity structures. However, a bit longer terms, private equity, I don't know, like often like 7 years. For for infrastructure fund, it's more like 10 or even 15 years. And there are also open-ended funds. So these are the types of structure that are more appropriate for infrastructure investments.
Thank you, Christian. Any other questions or comments?
Maybe would you allow me just to comment?
Yes, please.
I fully agree with Christian, but again, is it possible to have a infrastructure fund focus on Romania? Yes, we have venture capital funds and private equity funds focused on Romania only. Would it be optimal? Probably no. Would it mean that there will be a lower size of this fund? Probably so. So I think these are considerations, but I think more the question would be, if the idea is to develop the asset class with a long-term view, let's do it with the best possible, let's say, tools or portfolio structures that would allow for diversification. Because if the fund should invest in Bulgaria or Croatia instead of Romania for a particular asset, then so be it. But again, I think in theory, it's possible.
Yeah, I would just say to this that, like venture capital and private equity often is very localized. The markets are more focused. When it comes to infrastructure, there are obviously less infrastructure projects than there are like companies or startups. And in terms of size, I think I forgot to answer your question. It's a good one. In terms of size, normally infrastructure funds are larger than private equity or venture capital funds, just by nature of the project. For our CE fund, we are targeting like 50 to 150 million per transaction. And as Robert was saying, for a large investor like APG, they are targeting like a minimum of 300 million. So really, like, I don't think it's possible to have like small funds. Like you need to have some scale because just by the nature of the projects.
Yes, indeed. We heard from Tilman Luder and in the panel discussion about the Savings and Investments Union that, of course, this growth assets, private equity, venture capital will be very much in the focus of the European Commission and European Union now for years to come. And of course, infrastructure has been there all along with the Capital Markets Union, and many different actions have been taken, but still very much needs to be done. Any final words, any final comments, or do we just thank you, Christian, for an excellent keynote and for your support, and thank you all panelists for a very interesting and enlightening discussion. Please join me in thanking all the speakers.
We are going to be switching tack, switching focus now, moving on to our concluding session, leaving infrastructure behind, at least as an asset class. And we are going to hear from Tom Vandenbos, who's AI Program Manager at PGGM, on the topic of accelerating digital transformations by scaling up AI initiatives. So I'm pleased to confirm that we'll be hearing about artificial intelligence in this last session. Is Tom here? I'm just making sure that I haven't misread that. Yes, Tom. It's 4:50. Yes. This could be a surprise. I will not be able to stand in for Tom. Did recently watch a comedy show. Maybe I can crack some. Excuse me. Sorry, just bear with us. He's joining online, so we'll just make sure that we can connect with Tom, and then I will say hello and pass over to him. Yeah, okay, that's fine. Okay, we just, there's a time difference. Okay, should we just take 5 minutes or, yeah? Okay, we'll have a 5-minute break, but it's really just 5 minutes, so don't go too far. We're just getting him in, we're just getting him connected. Hi, Tom, can you hear us, see us maybe even?
Indeed, both.
Okay, we can't hear you yet, but we'll sort you out. We're just calling, we had a 5-minute break, so we're just calling everyone back into the room. Tom,
Yeah.
and then we'll get you started.
Sounds good.
So if you could take your seats, please. So I have the pleasure of introducing Tom again. Tom will be giving us a case study or presenting on accelerating the digital transformation by scaling AI initiatives. Tom is AI program manager at PGGM. He has been working at PGGM for over 9 years, starting as a trainee and working his way up to innovation manager, where he has responsibility for the AI program that he'll now be telling us a little bit more about. So if you could take your seats, please. And Tom, I will hand over to you. Thank you very much.
Thank you for the introduction. Let me share my screen. Just to check, everybody can see the screen? I take that as a yes. So yes, thank you for having me today at the conference. I wanted to talk about accelerating digital transformation by scaling AI initiatives with a special focus on asset management. So basically, I think it's a good idea to start with what's the actual definition of AI. There's a lot of different definitions of AI. The one that we follow at PGGM is the one that's defined by the AI Act. This is a whole lot of text stating what they believe AI is. We at PGGM just summarize that into, okay, an AI is a computer program for a specific task that is learned from examples. Then if you look at all the stuff that's happening around AI in the market, especially generative AI with ChatGPT, DeepSeek, you name it, then it's also good to talk about what are we talking about today and what is generative AI if you look at the whole artificial intelligence stream. So you have basically artificial intelligence as the main container of what it all entails. Then in that container, you have machine learning, which are advanced algorithms, and they can learn supervised or unsupervised. Then underneath that, you have deep learning, which are neural networks that basically mimic the human brain. And then you have like another part of that is generative AI, which we all know now because the entrance barrier to use it is actually quite low. So that's just a little bit about AI and what it entails. I'm going to talk a little bit more about examples and everything that happens with it. So what you see in the market is all kinds of new solutions based on AI. So here we had in 2023, for example, Google introducing text to music. So you enter text and then the AI actually creates music from it based on the text you provided. We also seen Sora, and Sora was introduced in 2024. It's the same concept as with the Google AI that I just showed, but the difference is that here it's text converted into video and also images. So this is already being used when creating well, animation, but also like real life videos to advertise stuff. This is an interesting one, especially for us, because at PGGM, one of the most important things is the healthcare sector. AI also enables people with disabilities to do stuff, see stuff that they were never able to do before. So in this example, AI actually looks at brainwaves and converts those brainwaves into images, not images like we can see, but in a different way, but in a way that someone that's been born blind can actually see for the first time in an abstract way. This example is maybe an example that a lot of people are familiar with already. This is augmented reality, basically used for engineers and engineering to help them maintain machines and the like. There's also an interesting one. This is more on the social media side of the story. So if you have all this information on the internet everywhere, social media, LinkedIn, you name it, then you could actually use like goggles or glasses that actually use augmented reality to tell you, okay, this bus driving here, there's no more room, so you don't need to stand in line. Then there is also LinkedIn coupled to this. So you can see, okay, this person works at this company. I'm actually looking for a job at the moment, so it would be nice to have a chat with this person if he's open to it. Or there's a roadblock, and the roadblock will be there until the 12th of August in this case, so I shouldn't go that way, stuff like that. This one is special to me because when I show stuff like this last year, 2 years ago, before that, I always take a picture from Japanese companies and tell people about, okay, this Japanese company has an AI as a board member or a news reader as an AI. Actually, this is a Dutch example, and we have a regional news agency that's actually using AI as a news reader now. So this is not actually a person. This is a copy of a person, and this is actually happening on the Dutch television. And then, of course, in 2022, in November, ChatGPT was introduced, which changed the whole AI space. And then Microsoft actually partnered with OpenAI, which lowered the bar to work with AI within our companies and within PGGM. And then last but not least, this happened a few weeks ago, DeepSeek. It's not that interesting what DeepSeek can do. What is interesting is how they can do it, because they lowered the bar for developing large language models a lot, which means another acceleration in development of AI within all sectors. If we look at all these developments, what does that mean for pension administration companies? For us, for PGGM, it meant that we started sprinting because, I mean, we all want to use this because this is going to bring us a lot of value. But where are you going to start? So what we did is we developed at first a model with APG, another big Dutch pension administrator you're all probably familiar with. And we developed a model that could understand voice intonation and convert that to insights into emotions. And we're actually very successful in developing something like this. This was 6 years ago. And then we tried to actually use it within our company, but we discovered, okay, now we have a great model, but our infrastructure, our IT is not up to par to actually use this in a responsible way. This is the moment where we said, as PGGM, we need a program where we're gonna work on the prerequisites we need to actually responsibly using AI. And our goal was to achieve our strategic goals by using AI as a tool. So AI is never a goal by itself. It's a tool to achieve something, in which in our case are the strategic goals. And underneath we said, okay, we are a pension administration company. We're not an IT company. We're not an AI company. So we want to be fast follower, which means everything that becomes available in the market, we should be able to adopt it and to use it within our company in a responsible way. 3 core components: identifying and applying AI cases, building AI competencies, and also setting up an AI ecosystem where we not only use or want to use data from other sources, but also incorporate AI models from other sources. And we ran this program for 4.5 years, something like that. And well, this program has ended, and I will tell you about what we're doing right now. The goals, because that's the most important about how you're gonna be using AI. divided into a couple of dots on the horizons, moonshots, we call them. And they're basically divided into the units we have at PGGM. So, for example, the digital financial coach for customer interaction, smartest pension administration basically entails optimizing processes, making them more efficient. AI is a governance advisor. So that's the institutional part of the company. So how are we gonna communicate strategies to our customers, to the pension funds? Of course, investment. So we want to be the best 3D investor. How are we gonna use AI to get there? And the last one is an interesting one because we receive a lot of data from the healthcare sector because they need to provide us with the data so we can provide them the services they need. But we also want to give something back about the data. So we gather it, but we also provide them insights into that data via, for example, benchmarking, and provide them with a data platform. And how can we use AI to provide more insight to our sector, to help them with HR-related challenges? So that's more about what we want to achieve. If you look at the business value, underneath, we also want to achieve something regarding maturity of AI within our company. So what do we need to actually do this in a responsible way? And we adopted this Gartner model, where you can see that in 2019, what we did was mainly interactive dashboards. But towards 2024, 2025, the ambition was to go all the way up into the level where we have AI that could make decisions by itself. And I will get back to that if that's something we achieved or maybe we don't want to achieve that anymore. I will get back to that. So if you actually put those together, then you can find the Gartner model here, divided into the 5 dots on the horizon, the moonshots. And we actually try to determine what the AI maturity is per moonshot. So every unit within PGGM has their own IT management. So that's how we try to look at it, because it's separated from each other in a couple of ways, not all, but a lot of them. And then we use this as a means to measure if we attain the level of maturity that we want to attain. And you see a lot of dots here with numbers in them. Those are the amounts of AI projects we have ran over the past couple of years, where you can see the running projects versus the finished projects. If you look at the past 4 or 5 years, what have we achieved? So we have achieved significant savings in euros. We have introduced a lot of programming skills for AI within the company. So not 2 or 3 people that can actually do this, but a lot of people doing this within units in specified teams. We also worked on a central IT infrastructure, introduced cloud as an example, but also introducing machine learning operations, for example. We actually brought 26 AI applications into production. So those are being used on a daily basis by various teams within the company. We also created our own private Copilot platform because we want to be in full control of our data and what's happening to that data. And if you look at our total amount of employees, it's about 3,000. We have 1,300 registered users. So you could say half of our employees are actually using this private Copilot at the moment. And we assisted 9 asset management teams with AI solutions. Then I want to show you guys something about the cases and some use cases. So if you start with AI, you need the basics to be in order. And one of the most important basics is the data. You need to have correct data. You need to have accessible data. And this is a project we are working on right now, where we actually put all the investment data together in one platform. There's Chinese walls in that. Oh, lights turning off here. There's Chinese walls in that so that not everyone can see all the data. But in the end, if you're a total portfolio manager, you should be able to see in an overview the total amounts. And here you can see carbon footprint, SDI percentage, and Paris alignment. That's how we try to measure if we are in line with those goals. But then over the whole portfolio, so not just per asset class. Then I have some videos explaining some use cases, because if you have this in order, if you have the data in order and you have the data delivery in order and the data management, you can actually start working on your AI applications. We built our private Copilot that I just talked about, and that's what you're seeing right now. And instead of showing you live demos, I created videos of them that would explain to you what this application actually does. So I will just let it run, and then I assume you can hear it as well. If you can't hear it, just let me know.
This powerful tool is here to help you refine and review your dataset documentation, ensuring every data point definition meets the highest standards of clarity, consistency, and compliance with your policy framework. Defining data points can be challenging. Ambiguities, inconsistencies, and non-compliance with policy requirements can disrupt your dataset documentation. The Data Definition Checker simplifies this process by assessing your definitions against mandatory and optional criteria, giving actionable feedback for improvement. Here's how it works. Enter your proposed data point definitions, and the checker evaluates them against key requirements. Mandatory criteria like clarity, singularity, and descriptive phrasing are assessed, alongside optional elements like precision and consistency. For each definition, you'll receive a compliance report with actionable suggestions to bring it into full alignment. With clear feedback and detailed suggestions, you can confidently refine your definitions for seamless integration.
So basically, this helps with getting your data in order. So we actually use AI to bring our data in order so that we can use that data then for other solutions. So, for example, we also create something for external managers, hiring external managers. Based on a couple of indicators, we let the AI do the research for us. So what's the philosophy of the external managers that are available? What are the prices? What's the performance? How are they working on sustainability? And then the AI will actually provide us with ideas and with proposals in how to go further, hiring the right asset manager for the right goal. Then what we also created is you can look at it like a text mining platform. And what it does is it actually takes a lot of information and looks through it and sees if in what way they adhere to the Paris alignment, to the SDG goals, etc. Also have a video of this that I will play right now.
This tool uses generative AI to unlock insights from companies' websites, turning scattered public information into structured answers. The tool collects data from companies within an investment portfolio and answers 6 key questions, from decreasing carbon intensity to greenfield fossil fuel investment. All automated across more than 200 companies and fully explainable. Take greenfield fossil fuel investment. The tool highlights whether a company plans to explore new oil or gas fields, a key indicator of long-term alignment with net zero goals. Or carbon intensity. The tool surfaces finds whether a company commits to lowering emissions relative to output, and whether it sets concrete targets to do so. And when it comes to low-carbon solutions, the tool identifies companies that provide or plan to expand offerings like renewable energy, biofuels, or hydrogen. These insights have already supported investment decisions. For example, data from the tool contributed to an informed decision to divest from fossil fuel giants, a move covered by national media.
Yeah, so we use this to actually determine if we want to invest or divest in certain companies based on sustainability goals. And then if you decide to divest or invest, you want to actually communicate about that. And we also created something for
this tool
doing just that. Also have a video of that, of the sustainability claim checker.
Do you have a sustainability claim you want to validate? The Sustainability Claim Checker verifies whether your claim is accurate, representative, and well-founded. Whether it's an annual report, sustainability report, or communication release, this tool helps refine the information in line with AFM guidelines. The claim checker follows a detailed step-by-step process, from fact-checking and consistency review to analyzing representativeness and clarity. The assistant also provides suggestions to make the claim more specific, up-to-date, and clear. Additionally, it refers to the correct sustainability definitions from the glossary, ensuring your claim meets the latest standards. With the Sustainability Claim Checker, you can ensure that sustainability claims are always aligned with the AFM guidelines without having to manually go through all the material. Do you have a
Yeah, so those are the examples I wanted to show today. And then you might wonder, are we doing anything with algorithms and trading? We are, but we don't see those algorithms as being AI. They are rule-based, and based on those rules, they do something. So they are not actually learning yet. And we do really doubt if we are there yet to actually do stuff like that, because what we see in the market is that the technology goes a lot faster than the governance for that technology and the technology that needs to govern all these applications. I will talk a little bit more about that in the next slide. This slide is providing you an image of where we stand as PGGM, where we think we stand, what's going well, what's not going well in everything that entails AI. I'm just gonna highlight the red part, which is scaling initiatives. For us, it's not the challenge to actually build AI, buy AI, or use AI. It's more, once we have built something, how do you get the correct maintenance teams on that AI, and how do you enable them to actually maintain it and to make sure that the AI, if it's machine learning and actually learning, keeps doing what it's supposed to be doing. It's all part of scaling initiatives and having teams within the company that are able to do these kinds of stuff. So if we look at our results of the past couple of 4 or 5 years, we need something else. We don't need to introduce AI anymore. We don't need awareness on AI. What we need is to have all our realized use cases to be managed within the company in the right way. So that we can always explain what models are doing. We always monitor if models do what they are supposed to be doing. And we can actually work in a responsible way with those. The other part is that we want the units and the departments to start working on AI themselves, because the past couple of years, it's been mainly 4 different teams within PGGM providing this for all the units and all the teams. But we need to enable those teams to do it themselves if you want to have AI as a core competence of your company, which is something we have as a goal now. And for us, for my team, which is innovation, we want to create like a continuous cycle where we explore new AI possibilities and applications, and make sure that we are able to use that so that we can actually share that with the teams within PGGM, which then adopt those new kinds of applications. And this is how we try to really create an AI competence within the whole company and not just in certain departments. And how do we try to do this? We have a steering committee, actually with executive committee members and also the CEO. And they prioritize use cases that have an impact on a general level, mostly on the IT infrastructure, but also on the governance of AI. Then we have an AI backbone, which for us is the people within PGGM that have experience with AI. They are also architects, a cloud service team, stuff like that, cloud engineers. And they're also in charge of establishing a secure managed AI platform in which the governance part of our company, so security, privacy, office compliance, is in charge of drawing up a governance framework within the boundaries of what we want to do with AI. The teams themselves should start working on AI solutions through stuff that's being offered to us out of the box from our suppliers, but also start building stuff themselves if that's their strategy. For the pension administration part of the company, they actually have an AI strategy now, and asset management is also working on that. And then when the units and the departments cannot go any further because our IT infrastructure doesn't have certain components, they share this with the AI backbone. The AI backbone translates this into concrete cases, and those cases will be prioritized by highest level of our leaders. And in that way, we try to accelerate development of AI within PGGM. What you can use today and what you guys could also use today, not everybody is a Microsoft company, I realize, but also Google, AWS, and the other ones, but these are the three big ones. They provide you with out-of-the-box AI solutions. So you don't have to build something, but at the governance level, there is a lot you need to take into account and you need to do. But the message I want to send is it's not hard to start working with AI, even if you have zero knowledge or experience. This graph, which is research done by university, shows in the blue the productivity of people not using generative AI as support. In green, you have the productivity of people using AI as support. And then the most interesting part of this graph is the red part, because the red part is people that are using generative AI as support, but also receive training to use generative AI as support. And what's interesting about this graph is that you see that the difference between red and green is very small, which basically means everybody can start with AI. You don't need extensive training to do so. So if somebody offers you a training in prompting or whatever, I would suggest not paying a lot of money for that. I want to end with the risks, because I talked a lot about what you can do with AI, but of course there's also risks to it. Consumer protection, security, privacy, ethical considerations, accountability and transparency. And you also want to have some freedom to experiment and to develop stuff with AI. And this is, of course, governed by the AI Act. A little bit about how we deal with that within PGGM is we created AI policies together with the pension funds, and we developed a quick scan to determine what the level of risk is of the application that we want to buy or build. And if we conclude that the risk is one of the three highest levels, we say that there needs to be a comprehensive risk analysis. And you can compare that a little bit with the GDPR and how you deal with the GDPR. We basically try to use the same process for AI. And then you have a risk assessment of the AI you want to use, and you log that into an AI application, of an AI management system. An AI management system then provides you with transparency about your model. So it explains on every stakeholder level what the model does in different ways. It also manages your AI compliance risk because it gives you an overview of all the checks you need to get. And it takes you into control of your AI model. So you want to be sure that an AI model does not start doing other stuff than you wanted it to do. So we actually start measuring model drift. Does this model still do what it needs to be doing, or does it do something else? If it does something else, we get an alert and we know we need to fix something. My last slide is maybe a little bit out of the blue and maybe a little bit weird, but I think it's the most important message to send today, AI is no magic. So don't expect if you buy an AI application, and the lights turn off here again. If you buy an AI application that it's immediately going to do exactly what you want it to do. You need to train it. You need to invest time in it with your teams. And AI is a tool and will never be a goal. Everyone that comes to us and says, I need to do something with AI, that's the wrong question to ask. You have a problem, and that problem can't be solved by the traditional solutions. Then you look into AI and not before that. Data is indispensable. If you don't have correct data, don't even start. AI will always make mistakes, just like humans will. So don't expect it to be without failures. And I think there's a lot of examples in the real world stating that you should always start without AI. Google has seen this, Spotify, Tumblr, GitHub. There's a lot of information you can find on this. I think the most inspiring story I have about this is that we wanted to have a model that anonymizes our data. And we actually started an experiment with a very expensive supplier with a big platform. It didn't work really well. And then we spent one day in creating a model which is rule-based that was perfectly fine in anonymizing our data. So keep that in mind. With that being said, are there any questions?
Tom, Francois Barker from Evershed Sutherland. It's a slightly self-interested question, but what happens if AI gets it wrong? Where's the legal liability?
Yeah, so then we are implying that we actually have something in production that can conclude their own answers. At the moment, we do not have something that directly communicates with our customers. So everywhere, every AI we use at this moment is being checked by a human. So when it makes a mistake, we actually see that it makes a mistake. We are not in this time yet ready, and I think that goes for all of Europe. And you see a few public-facing AI applications now surfacing to actually have AI talk directly to your customers yet.
Great. So lawyers have a future. That's what I wanted to hear.
Thank you for the question, Francois, and thanks, Tom. Any other questions? If not, then we just put our hands together to thank Tom for your very interesting presentation.
Thank you.
Thanks very much, Tom. And with that, I really just have to introduce our final speaker with some closing remarks. Jacques van Dijken, I'm sorry, that's probably very bad. Vice Chair of Pensions Europe and CEO of the Dutch Pension Fund for Medical Specialists. Jacques, over to you.
What a wonderful day we had, and how good it is that we are seated together here once a year as representatives of this very relevant industry. I have to excuse myself towards Gabrielle, who wrote a fantastic speech, which I will divert from. And I will divert from it as I heard Klaus in his opening address make a statement on the geopolitical situation that we're all confronted in. And that kept me a bit busy over the day. It kept me busy, by the way, over the last couple of weeks especially, but also very, very much today. Because I think we, as representatives of the pension business in Europe, we fulfill an important role in a continent that is the continent where liberal values emerged from. They spread around the world, but they are very relevant for our way of living. As a young boy, I originate from 1962. As a young boy, the border of Europe was at the eastern border of Western Germany. That is only 350 kilometers away from where my bed was. And then we had the fall down of the Berlin Wall, and Fukuyama wrote that he thought it was the end of history. Well, he is a fantastic liberal writer, but he was pretty wrong if you see what's happening to us today. I think Europe is a very important continent. We have a fantastic way of living. We have liberal values as nowhere on the globe. So there's something to defend. And within Europe, it is for me pretty clear that we have a very relevant role, by the way, by delivering pensions to millions of people. And because of this role, we invest money, and it has now become more and more apparent to ourselves probably, but also to the rest of the world, that we deal with a lot of money, and we can be the changing factor. So I think Pensions Europe, as representative of all of you, has always played an important role, but its role is more relevant than ever. And I hope when we all leave, we bear that in mind. Pensions Europe, our business pensions, is of extreme relevance. Let's keep on communicating with each other. Let's work together. When there is reason to influence the lawmakers in the EU, let's do that together, knowing that there is an enormous divergence between the members. Sometimes horizontal legislation is good. Often it is better to keep it country by country. But let's do it together. I hope you had a good conference. And before I really say goodbye, I'd like to thank our Romanian organizers who've hosted us. Thank you very much. And once again, the organizing team by Pensions Europe, all speakers, all moderators, all questions. Thank you very much. For the game, see you tomorrow. For the rest, hope to see you soon, but at least I see you next year. Bye-bye.